most people's problem with trading is that they hate their jobs or they hate their life to a certain degree. I can't wait till I go full time. You want to skip the process along the way. And trading and gambling are 1 degree off from one another. And when they go on that like negative technical edge, I tell them, my guy, just go play blackjack at a casino. You can look at a technical model and you could say, hey, this should produce this over a long period of time. And yeah, fair enough, it should. But then it doesn't. And then the question is why? Why people follow the traditional society structure is safety. It's not this hyper, like you've been brainwashed and whatever. It's more of it's safe. It's going to get you an outcome that no one can roast you for, so to speak. Of like, how do you roast someone that's making the median salary? Like, what do you say? Hey, you are average. Everyone's average. You're only seeing the clips of the people that have hyper made it a lot of the times. That's kind of the thing sometimes of like, hey, I could see why this person killed it, but I can also pinpoint a lot of those things in that person's history, which makes them the anomaly. So it's the anomaly telling the average, just do this.
You know, when you hear on the internet, just got to look in the mirror and tell yourself you love yourself and these kind of things, and people get caught up in the affirmations and the morning routines and the cold showers and this and that, rather than just getting to their to-do list.
When you tell someone, hey, learn trading, that's not a 2-month activity of like, oh, you're going to miss the next 2 weeks at the pub. No, you're missing the next few years at the pub. And they're like, well, I want to keep the pub. Sure. That's a statistic against you, so to speak. And I want to keep this and I want to keep that. And they try to put trading somewhere in their life versus the guy you were talking about that knows all their parts. You're competing against that person.
There's a lot of things we could talk about in trading psychology, and it is a fascinating topic, but I'm also sure there's an 80-20. What would you associate those two?
I have to think about how to say this carefully just so people don't get it confused.
Hello ladies and gentlemen, welcome back to another episode. I'm joined by a gentleman you may have seen around. He's flown in from Montreal, and I've flown in from basically Dubai. We're in Toronto at the moment, and I'm pretty sure this will be a good episode. I've seen a lot of your clips and content, so I know you have a lot to offer. So first of all, thank you for flying in.
I appreciate you having
I
me
look
on.
forward to having a more of a deep dive in terms of a conversation as opposed to just the sound bites we hear on
Of course,
clips.
yeah. No,
I think we can.
Again, thank you for having me on. I appreciate
Awesome.
it.
So yeah, from what I have gathered is, and you were saying you've maybe just become like known for psychology only, but it is a balanced thing. Like you are completely technical, and also you just have more than above average psychology knowledge. So therefore it seems like that's all you do and all you know, but of course it is a balanced thing. But I do want to use this opportunity to speak on the topic of psychology, mainly because I feel like a lot of people hear about it, a lot of people talk about it, but they don't know the why. And it's also something that's not so tangible, that you know that your technicals lead to an outcome right away. There's a quick feedback, whereas psychology is more paradigm related and it's a longer term feedback loop. So people just overlook it, or people use it as a cope and they're like, oh, my technicals is not the problem, it has to be my mind, and then they just go down that rabbit hole. So I think it's a very misunderstood topic, and the word trading psychology. Some people put too much weight on it, other people don't look at it at all. And I think this we can use as an approach to just cover some misconceptions and get into it. So first of all, I think defining terms is important because then we can tackle it. What does trading psychology mean to you?
It's how well you can perform over a longer period of time given the variables in life changing, right? Like when you kind of look at a lot of these conversations of technicals over psychology or whatever, the parts I've never really agreed with is it looks at it in terms of a vacuum, right? And you know, even in graduating engineering, that was one of the biggest problems I didn't like with it was, you know, neglect air resistance, neglect this, neglect that. And it's like, okay, very convenient for the problem at hand. But then you come into real life and then you kind of come into this thing where you can look at a technical model and you could say, hey, this should produce this over a long period of time. And yeah, fair enough, it should. But then it doesn't. And then the question is why? And you could say, oh, well, you executed on the wrong trades. Okay, possibly. Or it's the other side of it could be anything from like what connects the humans as a whole, right? It's the same idea of the person who had a father who's an alcoholic, you know, one becomes an alcoholic as a byproduct and he felt sorry for himself, and fair enough. And someone else was like, you know what, I'll never touch alcohol because of this and I'll build something of that, right? It's that mind connection that comes from that. And the same thing is within trading side is a lot of things have been dramatically simplified, and reduced. You know, and that's the side of, hey, like, just get on with it, or just don't let this bother you, or don't let this, right? And that's where performance really is. It's when life is happening, how you're doing it, right? And for over a long period of time, meaning someone who's winning and life's good, yeah, they tend to do well until it turns around. And depending on how long that is.
Survivorship bias.
Yeah,
basically.
right, that's it. So it's one of those things that, you know, it's looked at it within a vacuum, and I think you can make an argument for, hey, this trader has really shit psychology and whatever, but it's not about the anomaly. You know, like none of these conversations are ever about the anomaly. It's always about kind of combining it to the most average case.
Yes.
and then
yes.
bringing it up from there, right? So that kind of becomes a
Of course,
thought process.
exceptions don't define the rule, and,
Of course,
and
exactly.
people get caught up in the exceptions.
Yeah.
One thing I find with trading psychology is I might be on the another end of the spectrum to you, so I want to also divulge in that.
Go for it, yeah.
My
please.
belief, very very briefly, is that technicals can take you a long way. The idea being, I'm not a believer of, when you hear on the internet, like, you just got to look in the mirror and tell yourself you love yourself and these kind of things, and people get caught up in the affirmations and the morning routines and the cold showers and this and that, rather than just getting to their to-do list. And in a business format, I would love to compete with someone like that.
Of
That's
course.
someone spending 3 hours a day,
But that's not trader
red light
psychology.
doing,
of course, like
doing
that,
all these
no,
things.
But that's become like self-help 101,
Yes,
right?
yes. So I'm not putting that on you.
Yeah.
I'm more saying that's what I'm hearing,
Yeah.
and therefore I'm seeing that as a crutch, because if you have one nice bad sleep, you're gonna have a bad day. Well, I'm still gonna get my things done. So for me, it was, I would rather, and I think it's in life, it's more of a principle of, if you have negative thoughts but still do positive things, that's more important than having positive thoughts and then end up doing negative things, not doing what you need to do.
Yeah.
So I feel like a lot of people end up using this because of what they hear online. They're just, okay, let me just focus on this, and they go all in on just the things you hear on self-help and self-improvement. Whereas trading psychology, I don't think is that, and my belief therefore becomes that psychology is important, but I don't see it as a phase one topic. I see
It's
it as
interesting you say that, because
I see it as a
I
phase
know what you're
two,
going to say,
yes.
right? You acquire the skill to a degree, you get to a certain point, and then,
focus on performance and following your plan, because psychology is usually a case of deviating away from what you were supposed to do in your outline predefined plan, and therefore adherence. Let's say I've got a greed issue, so I keep jumping into reckless trades or revenge trading. All of these things are emotions that come out from a problem that you're going to face, and you don't know how to face them.
How do you know you're not facing it already, though?
So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
Right.
So this is the only thing I want to say. Let's say I'm a dentist, so
Sure.
I didn't go to university and we train the mindset. Or let's say you have a surgeon. You're not gonna have like the surgeon saying, "Hey, look, I don't really focus on med school. I was more focusing on my mind and stuff."
Sure, yeah.
It's always a technical base first, unless you have anchors. So
Yes.
if you have certain childhood traumas, you're not in a neutral position. You're in a bit of a negative position because you've got debt. You got 4 kids and debt to pay off. You're not in a neutral state. If you've got some issues mentally, you're not in a neutral state. So if you are in a deficit, let's say you've got some anchors in your mind, of course that needs to be addressed before you even get into the technicals, because you're going to be amplifying a problem. So that for me makes sense as a phase one. Psychology should be phase one in that scenario. But again, it's not the norm. I think the average person is more likely to be better found in focusing on their technicals, because then once your technicals are sound, psychology usually takes care of itself to a certain extent, and then when you find the real problems that are for an individual, then you know what to look at, and then you can look at how addressing them.
Yeah, I think I know your example and I agree with it from that point of view, right? I think there's one part that's not comparable within it, is almost like the feedback volume, right? Which is the idea of you can win a bad trade, whereas you won't have that in like being a dentist. You can't incorrectly take someone's tooth out and they give you a 5-star review and they walk away, right? So there's that side of when you start and you take trading, right? And one of the big problems that's happened over the industry over the last 3 years is people have assessments left, right, and center. Right, and I saw this on one particular firm. I don't even remember their name, but they had a beginner assessment, and I watched and like without even like realizing I read the rules. I was like, oh, okay, cool, like whatever. And I stopped for a second, and I was like, wait, what's a beginner assessment? I was like, it's the same market. Like when I'm taking euro dollar, I'm not taking euro dollar on the advanced market versus the beginner market, and then I'm intrinsically against now only beginners, right? And I was like, wow, that's such clever marketing, because someone might identify as a beginner trader, for instance, and he's like, I'll take the beginner assessment because it'll let me like feel the water, right? And that's kind of the same idea with stuff like this. It's less to do with the cold showers and all those things. Again, that's 101 kind of feel good stuff. Well and truly, it's everything you do as a person is a pattern behavior. Like as much as people have become anti the word pattern, anti the idea of whatever, you're not doing things at random. You're doing it because of your upbringing experience, the country you're in,
Absolutely.
the social media you see, your friends, all these thoughts kind of come in, right? So, and that becomes really interesting because now you can get conflicting ideologies, meaning, let's say you have a father, a hardworking man, but doesn't make much money, for instance, and, you know, traditional in the sense of, I don't know, he's a woodcutter. And he's like, no man over 45 can make over $45,000 a year. That person's a drug
Limiting
dealer or
belief,
whatever.
yeah.
Yeah. And then he tells that to his kid, right? And he says it, and his dad's a great man. All of a sudden, you're like, okay, yeah, that's true then. But no, the father was wrong about like monetary finances, but it's colluded with something else now. And it's the same idea with a lot of those things, which is a lot of the ideas and the things that inhibit us, it comes down from deep intrinsic patterns that we don't know. Meaning, at the same time, when you're having a technical edge, you're saying it from the point of view of everybody understands what's happening. And I think that's where we differ on it, right? Meaning in a sense of growing up, how much probabilities do you actually truly have in your life where you're actually met with a negative feedback loop, right? As a dude, you might ask out a girl, she'll reject you. Fair enough, that's one category of probabilities. Apart from that, what grades? No, if you have high enough grades, it's a bell curve. You know, okay, I want to go to this university, I have to be on this spectrum of things. It's not really probabilities, it's product outcome in that way. So most people don't actually experience risk. And that's why I think it's a bit of a reductionist argument to say just follow the edge in that way. Because up until the edge is acquired, you may not believe the process at all, right? And then hitting it with something as simple as just believe in the process makes no sense. Because just imagine someone you're extremely anxiety filled. You take 2 losses in a row, which is completely normal in your system. Are you going to believe that it's the system's 2 losses, or are you going to take it a shot on you? Because you might be someone who's filled with anxiety, maybe a bit of victim mentality. All of a sudden you're like, see, yeah, this thing never works. I'm not lucky. And you've created this identity that originally comes from something before. And that's where a lot of these things actually really come from. That, as I said, I do get your point, and I actually do agree with it in that narrative of like, because I'm someone who's actually a very data-driven person. Like I will make most of my choices off data and stuff like that. But I've also had years and years and years. Like I'll give you a most recent example actually. Bought a crypto last weekend with the geopolitical events in Middle East, right? I only said that because I'm not sure if it gets filtered, right? But you know, as the market, I was funny enough, I was away, I was on Airbnb, and the market had dropped like 22%, you know, and I woke up on that kind of because I was taking like a midday nap because we were out the night before. And I was like, oh, okay. I was like, that market's dropping. I look up just quick things like what's happening, right? All these rumors of World War III and whatever. And in that moment, I was with my friend, and we were just looking at each other, and we started laughing, and we're just like, damn, like, do we think this is it kind of thing, right? And so then I look at it from a technical point of view. I was like, hey, every structure is held. I was like, you know what? I actually think it was 2 obvious outcomes to me. Either this is World War III, in which case, whether I hold Bitcoin or Canadian dollars or bananas, it doesn't really matter. It's none of it is going to be valuable, well and truly. Or this is just a massive shakeout that's, you know, coinciding with a fundamental event, and then the market returned. So I bought on the spot, right? And it's one of those things of, can you stay composed in that moment to see that thought process? Now, why I was able to do this? I've been in crypto markets since a very young age, like by luck, if you want to have it as that. Meaning I've lived through 25% in a candle so many times over now that's the experience side coming in, where I was like, hey, this is just a day in the life now. You know what I mean? I've heard it got banned in India, got banned in China, President Biden attacked it, this person did this person did that. There's always a narrative, and that's kind of my point of, we can look at things within a vacuum, fair enough. But I remember, I think it was it the 2017 bull run or something, but some major person banned it, and everyone was like, this is the end, this is the end, this is the end, right? Same thing with FTX 2 years ago, same thing with all these things, right? In the moment of, if no other variable matters, yeah, I agree, technicals will always take over. But will that same person who, I don't know, your wife cheats on you, are you really going to perform your edge that day? And you might.
When it comes to, let's say, a predefined system, and I get that system and you also get the same system, and we perform differently, would you attribute that to being psychology?
If it's the same system?
Different outcomes, yes. Same methodology.
Yeah.
Same approach. That is a technical approach. And we're both given the same system, and we have vastly different outcomes. Would that be predominantly a psychology variance?
I would say so for the most part, right? Because it's going to come down to your perception at the end of the day. Meaning someone who's... You see this in... have you read Psychology of Money?
I have not.
Okay, you should. I recommend it.
It's a white and green cover, though.
Yeah.
Yes,
I do recommend. It's honestly one of the better finance books, just because it's like, it's not like filled with a lot of bullshit that's like talks about who knows what. It's straight to the point. Like, I think there's a chapter that's like 2 pages, and the author's like, I have nothing more to say, so let's go on to the next, right?
Okay.
But one of the ones that really stuck out to me, I think they had done a study. I never followed it up, so if it's wrong, don't. But thinking about it, it seemed legit. Was depending on when you were born would dictate your perception of the market. Meaning, if you were born during a bear market, you were almost like unlikely to ever invest.
Yes.
Whereas if you were born during a bull run, even when the market takes a dump, you're like, it goes up again.
Yeah.
And just that idea right there being able to take the risk, and I'm sure you know this, the greatest risk is taking no risk at all. But to someone who's grown in a pessimistic or like a poor background in that, and I don't mean poor financially, I mean like maybe risk defensive almost, right? And you tell them, hey, like this thing has to go down a bit before it goes up, right? Like regular long-term holds. If you hold crypto, for instance, yeah, it's going to see drawdown for a lot of it. I think the crypto market is mainly red over the course of its history, but the green significantly goes over, right? And it's like, can you understand that in that time? Or are you going to sweat? Are you going to get out of it? Are you going to be shaken out? Are you going to look for evidence that it's the same idea? And I'm sure you've heard, I think it's the Warren Buffett quote. It's the be greedy when others are fearful. Yeah, sounds very logical. Until, well, here's this World War III event. And I asked people, did you buy? And they're like, no, World War III is about to start. And I was like, so why does it matter? If World War III started, you're either dead or the value of your items mean nothing. So the better risk to reward is to actually buy, because if it's fake, the market rebounded, I think, immediately like half the value and then plus more. And if you're wrong, that goes to zero anyway. Who cares, right? That's sound of mind in that way. But tell that to someone in the moment who's not lived it. No, it's going to seem troublesome and worrisome and all those things, right? So
do you believe everything that is psychology related, which I want to define in just a moment, but what I'm gathering is like your input synthesized defines the outputs, where depending on what kind of time you were born, if you're born in a bull market or bear market, that input is going to synthesize an outcome. Also the family relationships you may have, because you look up to your father and therefore you take him as the superhero of your life, and then you take everything as
you could be taking advice from the wrong person,
and
right?
then later on in life you realize, oh, he's also just a human, and maybe he gets certain things wrong, and therefore you have to also absolve those limiting beliefs that maybe are put into childhood. So there are various things, but it looks like an input to outputs situation. Do you believe everything psychology related in terms of action is a behavior that can be modified?
To a degree, yes. Like I am, look, there's the whole, you can't teach an old dog new tricks. I don't fully believe that, but I don't fully disagree. It is harder, for instance, if you've been doing something wrong for 60 years, and then all of a sudden I'm like, hey, Waqar, like, dude, you're wrong about this. You're not gonna be like, oh, okay. You know what I mean? You have to fight it, because that's your identity now. Like, because there's a hard truth on the other side, which is your identity has been wrong for 60 years. Someone who's younger, and that's the same thing with experience. Experience almost goes hand in hand with psychology in that way, because you've seen something that stands the test of time. Like I remember when I was younger, in my early 20s, you do have that sense of immortality to a degree. And as I got to my late 20s, it's not that I lost that sense, but it's more of like, I was like, okay, I see where I was immature in that way, and it's the same thing with a lot of these psychologically driven stuff, right? Is I'm not dishing against technicals. I'm sure you need the edge. You can't unperform without it. But as I said, it would be a bit, as I said, it's a bit reductive to say these things don't matter, because well and truly they do. It's even coming into the markets, right? There's no barrier of entry, and people don't pay attention to that part. Like, I don't want to say because I'm not a super conspiracist or whatever of like, hey, the markets are meant for you to lose or whatever. But part of it, if you can enter it, well, there's going to be tricks. And it's like, if you're unfamiliar with those tricks, it's like if you take the average stats, right, and and the thing is about data, you have to be able to read data, meaning not every data point means what it means. There's always sometimes a bit of a caveat. I'll give you a random one. It had happened in one of the NFPs with Bidenomics. I don't know how much you keep up with that stuff, but NFP was supposed to show like how much job growth had happened over whatever, right? I'm sure you'll agree the last 2 years, economically speaking, hasn't been the greatest for the world. We can fundamentally say the world is more depressed, in a worse time, maybe on edge, feels like something's about to happen kind of thing. And yet bull market all-time high, all these things, right? So you can have an insane positive with a negative kind of behind it at the same time. So NFP came out really hot once, and jobs were more. The trick to the stat was, because he had said, hey, under my administration we've added more jobs, which was true. What they didn't show was the amount of people having 2 jobs instead of 1, right? So all of a sudden you're like, oh, look, more jobs have been created. And you're like, yeah, but more people are also working 2 jobs now, which inherently shows more people are poor, right? Like that they need to have to keep up with cost of inflation and stuff. And that's kind of the same thing. You come into trading, you have an easy barrier of entry. You have access to prop firms, which I think has been life-changing for a lot of people. I think it's both one of the best and worst things that's happened, because it's removed the seriousness and professionalism from it to a degree, but it's also given access to people that are good. You can level up insanely quickly, right, relatively to finding an investor and stuff like that. But at the same time, there's it's all a game now. You know what I mean? It's just do this, it's just that, it's my edge, it's this manipulation of this, it's the slippage, it's something else can be blamed. And then you realize it's, okay, well, is it because they don't know their technicals that well? Or it's because they're looking for a fallacy along the way? And you take that with like a conspiracist, for instance. that person's always going to believe everyone's against them. Is that not a, and that becomes problematic, because you might say, like, I'll just use a basic technical analysis, right? Let's just say a double bottom. You're like, this doesn't work because everyone's going to know about it. Okay, so logic says I'm going to take the opposite now. But then now everyone picks up on that fact of at a double bottom, you take the opposite. So now a double bottom is holding. Is it holding because it's the opposite? Or is it holding because, you see my reverse psychology? Thank you, right? And that's kind of the exact same point of a lot of these things, where we realize they become their own traps. And we see this a lot. Like, I've coached, hundreds of students now. They'll take a simple trade that our normal bread and butter trade, and I'll see it in the same screenshot sometimes, right? We'll be going through their journal, and you'll see like a 1 hour screenshot of their trade over here. And I'll be like, hey, just out of curiosity, why didn't you take this trade on the top left?
Which looks the same.
Which, and it's a better version, almost textbook. And they're like, oh, it just seemed too good to be true. And I was like, what do you mean by that?
Okay, so let me get into that specifically, because what that seems to me is a lack of predefined plan. So therefore, we can attribute it to a case of they were not good in their decision making, and we can maybe boil it down to some form of psychology issue, or it's a case of the predefined plan was not fully understood, or not strong enough understood to take an action. But when you do have a strong enough edge, and you know when to take an action and when to not take action, then it's a rule-based thing as opposed to a subjective emotion-based thing. To what extent do you agree to that?
Partly, I do agree, because look, I'm not saying no to technicals. I'm someone who's very data driven. I think as you actually get into the higher echelons of trading, where you're going to find those niche tweaks, it's going to be within your data points, right? It's that side of, yes, is it could you have missed some things in like your process and your plan, so to speak? Absolutely. And I think you can improve on that. Does it account for it? It becomes over the long run, I would say. That's where it becomes interesting, is when there's a real pattern, right? That's all everything is at the end, right?
So let's actually get into defining psychology, because there is certain pre-traumas that could be an anchor, and then it could be performance based. So it could be, I just jump in randomly and I get greedy and I get fearful and I don't take trades that I should be taking and so forth. And what I found is a very generic example of a case of someone goes through a losing period. So therefore they're like, okay, I've taken a couple of losses, let me retreat a little bit, just to weather the storm. Now, for example, if you're halving your ordinary risk, now for you to climb back out of that drawdown is going to take longer naturally. So now you're amplifying a bad situation when maybe the losses you were taking to take that drawdown was factored in. I have a 50% win rate over 10 trades, I'll take 5 losses. That could be win, loss, or it could be loss, win, kind of thing. So you took now an emotional based action for something that didn't need any modification. You just had to see it through. And what I found is people then start to deviate their risk. And then what usually happens is, because they're fearful, they will no longer take the setups they should be taking, that were the wins that were going to recover it. And because they were too fearful, and now you've skewed everything. So emotions took over and led to maybe a positive or negative outcome, but sticking to the plan would have been the best outcome either way. And another example I can give is, I like to modify my technicals or strategy in an approach that psychology doesn't become overbearing. In the case of, I know that I'm more likely to have psychology issues if I have a very low trade frequency, let's say once a quarter trade,
which is a sample size frequency as well.
And then it becomes a case of, if I'm swing trading, it's very ordinary for you to be maybe holding at your entry for a week or something, or maybe you face a 50% retracement, which is normal and expected, but not everyone can weather that retracement, seeing the numbers and so forth. So I know that I'm less likely to be having these thoughts and these problems if I have a trading set that I can take a trade 5, 4, 3 times a week. So higher trade frequency that is still predefined and has the win rate associated and so forth. And it's a more intraday base. Let's say you're trading with the session volatility, and therefore you can achieve your 1 to 3 risk reward instead of on a swing perspective, which might take weeks. It's now in the space of minutes or even an hour or something. So now that 50% retracement and holding that retracement for 2 weeks is less likely to happen. So I've resolved a problem through my technicals. I could go on to list a bunch of examples, but I think you get my point of the technicals, if done right, can also affect these anchors that we could speculate about, which is why I'm sitting on the edge of technical solves a lot more than trying to figure out psychology. What is your reflection on that?
I think, you can play with risk reward, you can play with how long you're holding something, right? It's this, and it kind of goes back to what I said at the start of, like, not every idea is going to fit with everybody, right? Like, even in a perfect situation of, you can have these models that are extremely high risk reward, but like 20% strike rate. And it's like, okay, great, on paper it's awesome. Are you actually going to get to that point of getting all those trades, right? And exactly as you said, it's like, you take a couple losses here to emotionally change stuff. that's kind of the side where a lot of these things really do come in. It's this idea of, can you see the plan start to end? I think if you can see the plan start to end, I'm actually going to shift my answer towards like that technical side of things.
So the problem is people's exhaustion curve, if we can call it something, is let's say your door-to-door sales. If I knew I was like the LeBron James of door-to-door sales, I know if I get 5 rejections, like someone slams the door on me 5 times, I'm going to be unfazed. But if I'm a beginner, that rejection might be very cold,
but it's exactly that.
And now I give up.
Something we talked about like in a thing in Reward once is this idea of like a timeline edge, right? Which is, and you see it with students all the time. Most people's problem with trading is that they hate their jobs or they hate their life to a certain degree. I can't wait till I go full time. And you want to skip the process along the way. And trading and gambling are 1 degree off from one another. You know, like that's the thing. After time, sometimes, and with my students know me, I'm a very straightforward dude and whatever. And when they go on that like negative technical edge, I'll tell them, my guy, just go play blackjack at a casino. Instead of taking this is slower, it takes 4 hours. Blackjack, 100 hands an hour, go for it, right? If that's what you want to do. You probably actually have a better edge because at least it's more mechanical in that way, right? Versus a fluctuating degree of poor analysis. You know, but on the other side, it was this idea of what you want to happen and when. And that's a big problem because you and I could look at Eurodollar right now and one of us could see long, the other can see short. One of us is going to have to be right. Now, from a technical point of view, we could both have our answers and it could purely just be probabilities and fair enough. From another side of things, it could be, we see it with prop firms. I need it to go 2% more to pass my profit target,
orientated,
right? Or I want to get that record payout, or I want to get this, or I want to get the whatever. Or sometimes you can even see it in these ideas that are actually good things, meaning like a lot of people you say, hey, why do you want to go like full time and be financially free? And they'll be like, well, I want to retire my mom. And it's like, sure, it's a good thing, but that doesn't like, that's almost like trying to use like positive karma to get positive probabilities in a way.
Yeah. I'm a big agreement of this, of like outcome orientation or external thoughts.
Of course.
I think these kind of things are major anchors and definitely need to be resolved. For example, as you're saying, people come into the industry because they're trying to solve a problem and they're not doing it for the love and passion of trading.
We all came into trading because we wanted money.
For money, and then it's always outcome oriented.
Vast majority of us didn't have a father in like a stockbroker or whatever, and for most people, again, using the average statistics, most people come from a median household or below average, a degree of entrepreneurship and maybe some rebelliousness to them.
And that's an anchor.
Absolutely.
Because now it becomes a case of I've got to prove it to my family. I've got to
do that for 5 years. Imagine for 5 years. You're 24 years old, right? And I'm sure a lot of people listening to this are going to resonate with this. You're in your early 20s, maybe either dropped out or thinking of dropping out. None of your peers are doing this. And now you have to be objective the whole time. And that's the whole thing. Again, a model in a vacuum, 100% agree it's going to be technical, play it out, no problem. But then in that moment when your mom's every day, hey, Habibi, have you got that payout yet? Yeah. Did you pass the FTMO? And you see the opposite as well. When you finally do pass it, you have to now prove it to everybody. So you rush to tell them you've killed it. And then you lose that account a month later because it was just maybe dumb luck. Maybe you got too greedy. We see this. I remember it was my Forex once I put this one out. It was the most wild statistic I'd read at the time. It was, I don't remember the exact words, but it was something along the lines of people make it to the funded account and then don't get they don't make it to a payout. So there's like another 35% that just lose right there, something like that. And I remember I was like, that's so stupid because maybe you spend $2,000 for the account, you pass. I was like, just make $40, I think was the minimum you had to make, get the refund, and then the account is risk free. But they were like, nah, I don't want to wait because I think at the time it was like 30 days before you can whatever. So they're like, I might as well get the biggest thing. They don't even secure the account payout kind of point. So the idea there is like, well, do you need rent money? Is it the greed? Is it there's a timeline of proof to someone else? And that's kind of my point, is there's so many factors that it's convenient to ignore them all. Sure, it works in that way. Whereas you realize what hurts most people is most people are not well off. Most people are, even if you were to ask someone like, I don't know, Elon Musk, it's a bit of a dramatic example, but if you're like, hey, do you want to make $1 billion today? He might listen to it, and then depending on what you say, he might be like, I'm unfazed. Now, not because he doesn't want money anymore, he's the richest man or whatever. It's more of he probably has a plan that will make the money. I remember it happened with it was actually BTC, because they had bought like massive amounts at 45k, and everyone was like, that's a technically poor place to buy, and I agree, it was. So the question is, why did he do it? And I was like, well, what if he only needed to hypothetically make, I don't know, 500 million profit? We don't know this. Maybe he wants to build a random Tesla factory somewhere or whatever. He spends a lot of money on Bitcoin, shills it a bit on Twitter. It goes up for 500 million and he sells. But you see it as like the average person, like, oh, Elon's buying at 45k. Surely this must mean this is going to go to $670,000, right? And it's like, no, this man doesn't need more money. There's nothing that's missing from him, right? Even if he makes X amount of money, right? Someone who's well off. There's a word in Arabic. It's shaban, which translates to like when you're full, like after you've eaten, right? You kind of feel full. You have no FOMO in that way. So then the choice is,
Satiated.
yeah,
Okay.
you're satiated. That's a good
Yes.
one. Yeah, yeah. And it's that same logic, right? Of you may not, someone from a poor background may not understand why someone else
not
ahead
the
of
same
them is doing
paradigm.
something.
Yes.
Yeah, right. I've seen it with myself, right? They're like, hey, if you're as good as you are, how come you haven't bought this thing or whatever? And I'm just like I remember for myself, like I know you're a watch guy, for instance. I love watches, but I've never really put a lot into it. Partly because we've been in a crypto bear market, and I just put it all into crypto. I was like, you know what, the watches probably
Opportunity
won't.
cost.
Yeah,
Yes,
I was like,
yes.
it probably won't appreciate in this time period. And I was like, after the crypto market, we'll pull it, right? Someone's like, nah, but you'd want the watch, and I was like, I really don't care, dude. Like, I genuinely do not care. And then they're like, huh, that's, there's that perspective
A
of
mindset
like,
difference,
yeah,
yes,
right.
yes.
And that's where all these things kind of come in. And even going back to myself when I was a student, I think what a lot of people do incorrectly is if they've decided to learn from someone, you have to actually be open-minded to learn everything from them. Whereas people kind of be like, it comes to trading, it's like everyone's a scammer, which I understand, statistically speaking. It's an uphill battle in that way. But when you finally do find someone, you do need to let your guard down, not listen to them selectively, because you're not in the position like that you want to be. They're clearly ahead of you. You've vetted them in hopefully good ways, but then you're listening to them with one ear and you're like, I don't like how he said that, or I wouldn't do that.
And the selective hearing is from your own psychology, probably.
Exactly.
Yes,
It's
yes.
your own upbringing. It's all of those things. And that's the problem with all these things is you can see someone 4 or 5 years into trading still at the first start, and you're like, well, are their technicals poor? Their technicals are not poor. It's their skepticism, it's their doubts, it's their whatever. They become
get
their
that, yeah.
like, we are at the end of the day like our own worst enemy. I know if you want to talk about on the high end, you'd be like, if the Matrix is after you or whatever, maybe that's a different conversation. But most of us aren't valuable enough for the Matrix to be after them, which is inherently a positive, I guess, right?
Do you think being rule-based is realistic for an individual to just know, this is my plan, if it doesn't fit these exact criterias, I cannot take the trade?
As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Do you think that's a realistic frame for a trader to say, even if it doesn't fit my plan, there's other reasons why you might want to get it?
I don't think
and
people
vice
know how to
versa?
think in probabilities.
Yeah.
So it's, again, most of my answers are defined on the average person, right? And that's kind of the thing is you have an upbringing of no probabilities or probabilities that don't matter because everything has probabilities to it. But there's that side of if it's inconsequential, it's inconsequential, right? And then now you say it on the rule-based side of things, and then you add the monetary side to it, which for a lot of people, especially take a 100K account. A 100K account for any country that's not a G7 country is a lot of money. So you're running 7%, for instance, and the most you've ever made in a month is sub 2K. I highly doubt that you're going to be calm and composed and cool and whatever, right? And we've seen this a lot with people. They get payouts and then they buy that really nice car, and sometimes it's really just to impress a girl, and you're like, wow, you needed a 50K payout to impress this girl who's dating your friend who didn't have the 50, you know what I mean? Like you can connect things that kind of happen along the way, which again, I do think the higher up you go, it's a lot of these things, it becomes an implied value, meaning like if you're playing in the Premier League, it's assumed you're one of the best at soccer if you made it there. You're not someone who's, hey guys, I've been playing soccer for 2 weeks now. You know, I can't wait to get into this, right? What happens in the high-end moments as well? Why does a soccer player miss a penalty? I don't doubt they've all taken a penalty a million times. And I'm talking like a straight whiff, not even like the keeper saves it. It's just straight missed. It's the pressure. It's that, and that's where someone of age and experience becomes more valuable. You know, it's not always the next hottest 21-year-old. Yes, you raise them and like cultivate them at the same time, but sometimes you're like, hey, we need the player that's taken this penalty in the Premier League final for the last 20 years. He's not that worried versus someone else. I think it's I'm not a huge soccer fan, so maybe this reference is wrong, but like I think Kane whiffs a lot of them, you know what I mean, like in the late stages of things, like there's that Kane effect that becomes its own psychological thing of you've set precedent in that way.
Now.
Yeah,
Yes.
you're like, I miss it all in these moments, and all of a sudden that becomes self-fulfilling because
Yes.
you're like, I'm gonna miss it, you know, and that's kind of the dangers of an incorrect identity, because a lot of these things can shift our beliefs, they can shift our moments, they can it's the same thing with if I tell you, hey, there's a 90% chance of this happening and a 10% chance of the other thing happening. You will believe the 90% with your full existence. But if the 10% happens, you won't believe it with the same 100%, so to speak. You'll believe it with like amount. So when it happens, you're like, wait,
What happened here?
what happened here? Like, I wasn't supposed to lose here. Right? And that's the side where these things and then the damage control that kind of comes in with a lot of these things, right? And that's where the conversation leads. I think most people can take a couple of losses. I don't think people are that fragile. But I also don't think people can take 8 or 9 losses. It's that spiral. They fall out of control. They get away with it. And for you to just say at that point, hey, this is just follow your rules. At that point, it does feel a bit of akin of like someone who's having anxiety, like don't have anxiety. You know what I mean? Like, I'm not trying to reduce it to that, but there is a degree of, we can skip the steps and say, this would never have happened if you followed all your rules.
Do you think ability to understand root causes and understand the exact problem is a major step into the solution? For example, if someone's feeling sad and they don't know why they're feeling sad, they just know they're feeling sad, and therefore they have behavioral changes based on their sadness. When you can start to realize sadness could be a fact of you have too many choices. You don't have enough choices. And anxiety is the idea of you have too many choices and you don't know which one to pick. So, in these cases, the action is either find more outcomes or take a decision. And that could usually solve your anxiety or sadness. Behavioral changes can usually solve the problem, whereas people will sit in their emotions. And now what they'll do is they will internalize it and make it an identity, as you said. And now that's going to be a self-fulfilling prophecy that that every time I'm on a losing streak, I always mess it up and make it worse. Every time I'm funded, I always blow it. And now it becomes
spot on.
Now it becomes an identity. You believe it, and therefore you start to take actions more in line with that unknowingly. What I've found is self-esteem is an important one in trading, and confidence is an important one in trading. And when we spoke about external factors, I have to prove it to my parents, I have to get funded, I have to impress. It's because you're too concerned with the externals, you're too concerned with approval and so forth. But failure is not the issue, because when you lose in a video game, you're not embarrassed, you're not stressed, you just lose, and it's okay. So losing is not the problem, it's people's perception of you when you lose, and you think people are going to think X, Y, and Z, and you're more fearful of that, not the loss itself.
It's also believing where you should be at like this point in time.
Timeline-wise,
that one's a dangerous one, right? Like,
so what I've done for myself is I just know my greatest judge is not my parents, it's not my friends, it's not social media. My greatest judge is my future self.
How long have you been doing that?
Not too long, but I'm also almost a decade in the game. So the reason I'm saying this is because there's an evolution, and we are talking to the beginner trader, and I think what we can talk about is from our experience, what we are doing, so that they can mirror it, as opposed to what they hear on internet, which is meditate and XYZ, when there's probably more tangible things to do. And what I found is confidence. It was like, okay, I've got to be confident, but I didn't know what it meant. Until I understood confidence is more probability, statistical thing of the percentage likelihood of an outcome based on probability. So I know that every morning if I go to the gym, the likelihood of me going to the gym the next morning is quite high. So you got confidence based on previous outcomes. So therefore it's not a feeling, it's a data thing. Self-esteem as well, it's not necessarily a feeling, it's your echo chamber of who are you listening to. If you're listening to your future self and your judge is your future self, you're not going to be concerned about 2 losses or losing accounts. So it's these paradigm shifts. So bringing me to my question of, there's a lot of things we could talk about in trading psychology, and it is a fascinating topic, but I'm also sure there's an 80-20, but there's a few things that go a long way and are actually a bit more tangible. What would you associate those to?
It's funny because I do agree with the points you made there, in terms of like something I did, like a bit of a life hack for myself, is almost look at like my life as like a price action chart, right?
Okay.
And it's almost like, what evidence would it prove there? And the longer you can do something, the better. I'll give you an easy example. Part of what I did with buying crypto last week, I had lived through many moments that it was supposed to die and it didn't. So now I'd lived X amount of them. I don't know, it feels like it's been like 40 now or whatever. I was like, well, 40 times it hasn't died now. Why is this going to be the one? Right? Yes. Whereas if you're in your first one, you have no evidence prior. So when you tell yourself and that's why it's like when I was saying like the self-help side of like the 101, you're going to write down I'm a great trader or whatever. What evidence do you have for that? So you're inherently lying to yourself, and that's not the trick with it, right? And whereas if you can kind of design something, like even it was almost like something I did was a reverse insecurity, right? In the sense of like, I needed braces once upon a time, right? There's nothing I could do about it apart from getting braces. Like, I can't think about it. I can't encourage my teeth to move. I can't stare in the mirror long enough or whatever, right? I go to my dentist, I did Invisalign, and I was like, hey, like, what's the like timeline expected on this? And he was like, about 2 years or whatever. So I was insecure about my teeth up until that point. But logically speaking, I was like, well, okay, I've been insecure about this for like 20 years. only 2 more years left now. I was like, you know what I mean? Like the second I start this, I was like,
Yeah.
I've already been insecure so that's not a new feeling for me. But it can end 2 years from now. And it's not like 0 to like at 2 years your teeth are just like fixed and good.
Along the way, yeah.
It's somewhere along the way, 6 months in, 7 months in, whatever it is, it becomes something that's kind of better. And that was the same idea of I had sat down once upon a time and I took everything that I didn't like about myself, whether it was physique wise, whether it was language, whether it was teeth, you know what I mean? Like all that things. I put a timeline guess onto some of them, meaning again, Invisalign and dentistry. The guy told me 2 years. So I'm like, that's 2 years.
So it was your exhaustion curve. You just knew to see it out long enough.
That's it, right? And you build it in that way. But also along the way, when you start, like, even with something like as simple as the gym, most people know you won't expect results along the way. And it's such a funny curve, that one, because when you go to a gym and you go frequent enough, you really do see the people that are extremely ripped and all that. And you see people that are, like, almost always at the start. Like, I don't really kind of see the middle people when you go more consistent, so to speak. And that's because at some point you look yourself in the mirror and you're like, I don't like what I see. And you have 2 options, keep going or kind of cancel it, right? And it's the same idea of if you can kind of build your life in a way where most of the actions, if you were to zoom out on a probability curve, would end up in quote unquote the best version of yourself, it will add up and it will get there, right? It's just knowing along the way to stick the course. Like now in my case, for instance, I'd always made money online such a very young age, and it was one of those things that, did I have anxiety when I went against the curve? 2 degrees, yes. But to other degrees, I'd already had history of making money online. So I was like, you know what? We've done this from the age of 14. Why is this any different now? We've done it once, we've done it twice, we've done it 3 times. I became my own historical price action. So when I tell you, hey, Waqar, I don't quit, I'm sure I've quit on things in the past, but I do know in my last decade of experience, so to speak, on the things I actually commit to, no, I fully see them through. So then it becomes a deciding choice of like, okay, am I going to commit to this thing and give it to my all? And same thing with understanding price action and different environments and stuff. Whereas people, you can see it a lot now of people don't value that experience anymore, meaning someone could be like, oh man, I've killed it in my trading the last 2 years. Okay, if the market was trending for 2 years, which happens, it's very different than consolidative market. And a lot of people will give, and 2 years is deceptively long and short. Like you can do a lot in 2 years and look back and the thing you've been used to, all of a sudden you're like, yeah, life's great. You scale up, you scale up, you scale up. And it's that idea of if you follow everything along the way, that it should just infinitely scale up. And it's like, no, it doesn't work like that, right? Like, and that's, I'm sure you run the compound calculator. We've all done it. You put $100,000, right? And you're like, oh, I just have to make 32% a week. And then I'm a billionaire next year. You know what I mean? And then all of a sudden you're like, this didn't go to plan, right? But it's, if you build your life almost like a price action chart, what would it say? You know what I mean? Like, would it really show you succeeding at the end of it? Are you something like do you metaphorically break out, or are you someone that's going to consolidate a lot? Or every time you have a false breakout in a way, right? You move up, you move back in because you don't commit long enough, or you turn around, or you don't believe in it well and truly. Not having that belief, if you're going to wait for that feedback loop, like that's why they say with like the best entrepreneurs and stuff, you have to be a degree delusional, which I do agree with. Because if you don't believe you're going to kill it, like through and through, there are so many things along the way to convince you otherwise. People at the end of the day, why people follow the traditional society structure is safety. It's not this hyper, like you've been brainwashed and whatever. It's more of it's safe. It's going to get you an outcome that, yes, no one can roast you for, so to speak. Of like, how do you roast someone that's making the median salary? Like, what do you say? Hey, you are average. Okay. Everyone's average, like, that's the whole point, is it's based off the aggregate statistic, right? So I guess the biggest side of things is to understand where you come from and where these things kind of happen. And that's why we've put such a strong message on it, because for a lot of people saying it doesn't matter, you see those, you're only seeing the clips of the people that have hyper made it a lot of the times, right? And that's kind of the thing sometimes of like, hey, I could see why this person killed it, but I can also pinpoint a lot of those things in that person's history, which makes them the anomaly. So it's the anomaly telling the average, just do this.
That's what I feel like I do.
Yeah.
And therefore my position is probably not the average person's position. The reason being is I've got 8 years under my belt. So therefore the things I've experienced in those 8 years, I'm maybe standing at the top of a small mountain.
It's funny because I would agree with you. Like as a one-on-one, I'm more on your side. As a teacher, I would be against it, right? Because I grew up like in
do you think it's better to explain, let's say people that have influence, we're on the internet, people are watching us, do you think it's more important that we say our truth of what works for me, this is my experience, and take it or leave it, or do we try and cater for their ears?
I think you can do both, right? Okay. Like in the right medium. Look, the thing is with reels and all these clickbait titles, there's a degree of you want the impressions and the thing. I get that totally. There's a marketing side that I'm not going to be delusional to. But then there's also the side of the authenticity of the message, right? Of like, who is this actually like meant for? So someone like myself, like I don't know how much you know about my history because I talked about it in the first Risk podcast I did with him, but like I made like a lot of money running a virtual casino at a young age, right? Did I know this at the time? No, I just right place, right time. I was taught probabilities. I was on the house. You know what I mean? I was there. We ran it for years. And then all of a sudden, I saw every sequence of probabilities that you can spew. I've seen thousands come in, thousands leave. I've seen when we've had a positive edge of near 73% and you still lose like 10 in a row and you're like, and it's mechanical. And I think that was the part that really showed it to me because my peers or whatever, right? If we lost enough, they would go then verse each other at a lower edge. Right? Okay. So meaning, let's say me versus you as a bettor, I have a 73% chance of winning. I lose 10 in a row, then I go against my boy because he's my boy. I have to give him a 50-50 edge to make back the money I lost. And it's mechanical, meaning it's like, it's not like TA where you could be like, hey, this is a high test candle and you actually misread it and it's a completely wrong candle. This is press roll. Like you can't mess this up. And yet, despite that, and it's funny because we had some friends that seemed to lose more than others, and we're like, hey, he's shit at this. It's the same sequence that we're all on. It's the same game. It's the same everything. Every variable is controlled. And yet, we all agreed, this person's garbage at this. And it's like, how can he be garbage? It's just a sequence, right? But then he would tell you, oh, yeah, don't let me take it. I'm garbage, right? So a lot of these things showed a lot along the way. And I think to go back to that point, it's the message has to kind of go out to who's it going to benefit most people? And in that case, you have to see it around the eyes of either the demographic of where they are in which country, right? And the demographic of what most people actually do. Meaning if the I don't know what the average salary is, but like assuming it's like 2-3K a month or whatever, their perception is going to be alongside that, right? Like you tell someone, hey, don't use coupons to buy the tomatoes for like 90 cents instead of $1.50. They're like, why? I'm leaving money on the table. It's because it takes you an hour and a half to go to the right supermarket to get it.
Yes.
You valued your time at $1.50 without the wear and tear, the gas, the tires, the whatever. And that time that you could have been doing. Now, if you told me, hey, there's a flash sale on, I don't know, toilet paper, and I can stock up 10 years worth for 10% of the price, yeah, that's actually a smart thing to do. How many tomatoes can I intrinsically buy on a discount? If I'm one person or a family of 4, I'm going to have, I don't know, 20 tomatoes or whatever. I can't buy 600 tomatoes because of the flash discount on tomatoes, right? But my point is they're thinking it's a defensive thinking. So when you're defensive, you're thinking about protecting. You're not thinking about expanding. You're not thinking about taking risk. And then you're telling this person, hey, just follow the model. Like, just follow. It won't work like that, right? So it's that side of finding of our own experiences. Like, I understand you've had a more unique upbringing, which is incredibly awesome. But to most people, you have to assume to a degree they've followed the trajectory of high school, this, peers, pubs on Friday nights, like whatever it is, right? That's standard FOMO. When you tell someone, hey, learn trading, that's not a 2-month activity of like, oh, you're going to miss the next 2 weeks at the pub. No, you're missing the next few years at the pub. And they're like, well, I want to keep the pub. Sure, that's a statistic against you, so to speak. And I want to keep this and I want to keep that. And they try to fit their life, like they try to put trading somewhere in their life. Versus the guy you were talking about that knows all their parts. It's like you're competing against that person, you know, and that's kind of the idea.
It seems like we've boiled it down to like the major topics would be an element of self-esteem and confidence. I think an identity was a big one, and I think I'm in agreement. The biggest one is time. Staying in the game long enough and not dying, so that you can see through. Because I've weathered all of the emotions. I'm not a particularly savant. I'm not a saint. I'm a normal human, and I've had the losing periods. I've had the blowing accounts. I've had all of these things, and it's the thing you said. Once it's your first time, it's a lot more of a painful experience than the 20th time. And when you've just had time in the game, you will just get better by virtue. So we've talked about like psychology overarching, but I want to also get into like day-to-day problems. For example, you're having a losing streak, or let's say you're feeling greed. Let's say you're feeling doubt. All of these actual like real problems that someone can say, I'm feeling this week, because childhood traumas and self-esteem and confidence is a more long-term thing. But what about day-to-day? What would you say is like the 3 major challenges traders face in a day-to-day emotion?
3 major challenges in day-to-day. I would say the major thing is trying to force something every single day. Right, I would say prop firms are part of the problem in that, right? Or especially the original evaluation, at least
30-day time model.
Yeah, the 30-day one, that was wild. You know, like that was like, hey, just make 10%. Like I'll give it to them. It was clever. But I remember at the time I was like, wait, isn't like, because I remember I guess I grew up in a more humble time that if you made 10% of the month, you were more akin of a god. And then to them they were like, just do it. Like
it's become normalized.
Yeah, and it's extremely normalized. But you see this on Twitter too. You tell someone, hey, I've made 3% this month, and they're like, pathetic. You know what I mean? They're just like, dude, like don't trade. Go back to McDonald's. And you run the same math. You do the 3% on 500K, a million, whatever. It's like, dude, that person's financially free completely.
Yep.
Yet it's been very
trading, I've always found, as I've got older, it wasn't so apparent to me when I was younger. It's only more recent. Is trading is not a game of return. Trading is not a game of win rates or risk to reward or trade frequency or anything. It's a game of capital.
Yeah.
And if you can pull out small consistent gain, that is way more sustainable and is going to achieve the outcome you want, as opposed to this hyper parabolic or this ping-ponging, yo-yoing 2%, 100% month kind of
well,
variability.
we see it again. A lot of these, like, usually, like, I don't want to blame the prop firms intrinsically because they're kind of just doing their part. But if you look at the evaluation model in itself, it plays on people's psychology because it forces you to gamble, especially when it was 30%. Are you really going to risk 0.25 per trade? Absolutely not. You have to catch a series of whatever. So you're then forced to risk 2, 3, 4% at the time. You lose your first 4% trade, and let's say the valuation is $1,000 for the 100 or whatever account it was at the time. If that's half your monthly salary, you're not composed right there.
Yes.
So it does these things that it puts you. Now, obviously, we've gone to unlimited trading days. Okay, great. That was removed from the equation. Did it affect the data? I think it slightly did. I remember at the time, I think it was one of the firms had said, like, they were like the last to change the trading days, and they were like, well and truly, most accounts are failed within 4 days. And I was like, wow. Like, that's why I didn't want to do it. They were like, we'll do it because it makes no difference.
Yes, to the bottom line.
They're like, whatever, right?
I've heard from just speaking to people that the number one contributor to blowing accounts is not the time, it's not even the percentage gain, it's not even people going into drawdown and blowing the whole account, it's the max daily drawdown.
Yeah, the daily.
Meaning they mess it up in a day.
Yeah.
Which is a strong indicator of something. What would you speculate that is?
I think it's the rush to get funded, honestly. Like, I can't speak on behalf of the data because it's hundreds of thousands, right? But if you see a commonality in that, right? Like, at the end of the day, the cool part about prop firms, and the one recommendation I give when studying data, is look at the obvious data point and what it means. And it's so funny because it's so obvious. I remember at the time, my Forex funds was still around. They were like still number one at the time, and they were putting out a lot of data. And it was this idea, and they said something. I remember they were like, our best traders are making 3-4% a month. And I was like, and that's the only data point that mattered for me, because it's two things that you can either read from that. You can either say, these people that are claiming to make 50-60% a month, well, if they were, they would say that, no? Like, surely they'd be happy to say, we're paying out $8,500 million every month versus whatever, right? Like, that would be in their best interest to get more people to kind of come in, right? And you kind of follow that logic down the line of realizing, okay, what's the main data point that almost discredits every other data point, right? And that's the thing of when you see 97% of traders fail, or 95, whatever it is these days, right? Funny enough, that number has held true throughout time, right? Whether it was pre-prop firms, pre-whatever, pre-ICT, and like, look, I'm not an IC trader, I'm not here to shit on it, but it's that idea of like, it was supposed to be like the holy grail in that way. Wouldn't the data reflect that? Like, well and truly? Like, if I was FTMO or whomever, if I found 200 amazing traders, why am I still open to new evaluations? Like, well and truly, if you found 200 phenomenal traders, why not close the firm, copy their trades, up the risk on it, and, that's it. It's done. Why run the chance of this dumbass coming in and and it's funny because we talked about it for years, which is like CPI would get banned. I was like, because I remember for a time I was trying to see, I was like, how are they balancing this book? How do you intrinsically, when X amount of thousands of people are going to come in to trade this thing, because we know it's a big candle is about to come, you're supposed to copy the trades, and half of them are going to go long, half of them that's assuming half, but again, that's a false data point because we just assume the ratio will split itself. Maybe that day it's 80 of them are long, 4%, 5%. So depth of market doesn't matter anymore because, you would argue it's a demo account or whatever, but it's not true at that point, right? In terms of filling the book. So you realize a lot of these things have set the trader up to fail because they see CPI now, which thankfully now, it's not banned on the challenge level, but you see it at that level and they're like, hey, I want to make that money all today, that I could do this. And you see the tight stop loss and whatever, and it conveniently slips a lot of things of like being filled correctly, spreads widening, a degree of manipulation from the firms, you know what I mean? Because like, let's be real here, they're not completely filling something, especially on a red news event where they could get away with it. It's that side.
Yeah, I've never understood that one because it's a simulated environment. How can you have order filling problems in a demo? But anyway, the point of ICT, so let's say it's a case of it's argued it's a superior technical edge, and be that it may, I don't know, but a lot of people advocate for it, so there's maybe virtue in that. But if so many people are vouching for it and saying it's the best, and then the data is probably not reflecting that in the prop firm data that we see, would you say that variability is not, therefore the problem is not ICT or his modeling, it's the people trading it, that they can't adhere to something and follow it? Meaning, say, would you boil it down to a psychology issue, not a technical issue, when you say ICT
yes,
trader?
because there are some top IC traders that I know that do well, right? And the difference is if ICT was the holy grail of trading, it would have just taken over. Yet, funny enough, I remember I think it was one of the firms they put out.
It's taken over on social media. It's not taken over
in the prop firm, but in the Twitter, YouTube,
yes.
exactly, right? But it's taken over in that side of, even if you look at mass psychology as a whole, if we know retail traders are inherently wrong, and now we have all the retail traders telling you we trade this way, I feel, and I'm not saying this as a shot, I'm really not. I'm just saying it of, if most people tend to be intrinsically wrong, and most of the people here are not profitable, yet all these people will vouch it's the way, there's a discrepancy in the data somewhere. Someone along the way is not doing something.
I've got my own doubts on this, because I don't know the answer. I don't usually go into finding whys. I just go on, I see it, and therefore I'm going to act accordingly and not speculate on how it happens, because maybe it gets into the matrix. I don't know. But for example, it's very apparent to me, the idea of liquidity in the market, a run of liquidity and manipulation. It's so apparent because I have a catalog of evidence. And I have got a little bit of like the ICT people are like, no, you're wrong, whatever. But I'm like, don't worry about my opinion. It's not, I don't care about my opinion. I'm just presenting an argument. This idea of a smart money trap. And this concept, I didn't even, not even a concept, let's say this idea didn't appear to me in the market 10 years ago. It's appearing to me more now. The idea of the typical smart money kind of thing, which is a build up of liquidity, a run of liquidity, and then a push down. Price will come back to that area and then manipulate it and then actually go down. Meaning the manipulation got manipulated. I've just termed that a smart money trap because I don't know what it is. I don't care what it is. I don't care how it got there. I'm just seeing it almost every day. And then people say, no, but I wouldn't have taken that trade. It doesn't matter about you. It's a matter about what a lot of people would have done. And therefore I'm just like, okay, well, I'm going to add that into my modeling. If I see a manipulation of a smart money trap within a relevant time window, relevant instruction and so forth, I've entered that as a trade model. I've got data for it. I've posted dozens and dozens of examples and people are still in denial. That's whatever. The point I want to get to is I just don't understand why. And the thing you were saying of people see a double bottom and then they're like, oh, that guy's manipulated. Now because everyone's not taking it, it actually plays out the reverse psychology and so forth. In theory, that all makes sense to me. The smart money trap makes sense to me. But when I look into it, I'm like, well, prop firms, where majority of traders are, is a demo environment. It's not making it to the market. Brokers are most likely booking you. So retail orders are never making it to the market. So when we see these retail kind of things, a trend line that gets manipulated, a double bottom, anything that's getting manipulated, well, it's not really the retail trader. And even if it was, their liquidity in the grand scheme of things is a drop in the ocean. That's our own doubts I have. I don't even delve into it because I just see it and I trade it. I don't look into it. But do you have any?
You covered that
because
so
you
well.
mentioned it.
No, you covered it so. I love that you said that, right? And it's that side. That's why I find it hilarious, right? In terms of what you discovered there, and I don't know the exact reason if I'm honest, but it's your experience of like going through your data, constantly improving. It's that your hunger to get better. So you've noticed something that you probably actually has always existed. It's not something that changed it, right? And I think that's the difference. That's why I never like the terms manipulations and traps, because it means targeted in the sense of like when you say manipulation, it means someone sat there and they took you out. The problem is when you move euro dollar up 60 points or 20 points or whatever, you're not moving against other people. Meaning right now, if Bitcoin dropped 25% when or the total market cap, right? When it dropped 22%, who is that not dropped against? Right? It's not like everyone is. So in that moment, if I'm institution or I'm some co-fund, the value of our portfolio has dropped in that time. So and that's the thing why I've always had these problems with these matrix arguments and manipulation and stuff, because either everything is rigged or nothing. Well, not nothing is rigged, but there still is collateral damage.
Yes.
Right? And that's the thing of it, like where people get it with the whole matrix idea and stuff, right? Like, look, God bless Andrew Tate and everything he stands for, I guess, or whatever. But if the matrix is real, I'm sure it's real to him because he's actually someone who's at the highest of levels of politics and things like that. To be targeted. Whereas you trading, as you said, none of these orders. So we agree that ICT and SMC exists at the YouTube / prop firm Twitter bubble, and then that bubble is also demo. Who's exactly targeting these demo stops? That would either mean FTMO is targeting us, and they've manipulated the trading view data. Very impressive. Or these are traps that people have just always fallen for, and it's the same cycle. Now, I'd actually argue it's things that have always existed that is only can be seen from thousands of hours in experience. I'll tell you a different example. When I was in university in my engineering, I realized that my professors repeat exams. Now, I started studying previous exams and not the actual course data, right? I skipped all classes. My friends know this. They'll vouch for this because I was studying my trading. I was like, dude, if I can minimize my degree, and it was a bit of a bet on my side because I was like, hey, I never worked a day in engineering, right? Like this ring, it's like in Canada, it's for engineering.
Okay.
Never worked a day in it. You know what I mean?
I never worked as a dentist either.
My guy, yeah, exactly. Right? And I was like, it was that full bet on that, right? But in realizing they repeat the exams. Now the question is, would you have the balls to study only previous exams to go into it? Well, it's that poker logic of playing the man. And I was like, well, okay, he's tenured. He has no reason to get fired. He has no reason to leave. Why would he? Making an exam is actually hard. It's not like elementary school where you can put up with something like these advanced engineering concepts.
It's a limited field of questioning.
That's it, right? You have to really think it out. I was like, yeah, he has like 3 past exams. He's gonna mix and match. You study them, and you know what? Over the 40 courses, I think like 37 of my exams were repeated, right? And the ones that weren't were soft drafts of the other ones.
In my degree, there was a big black market for people who could leak the previous exams.
Yeah.
And then
we had the same thing.
Same thing, content bank or
but
question
my point
bank.
Is, right, is the psychology, the man thereof, he had no reason to change the exam. The passing, because the distribution of students that studied everything still was there. The students that didn't study shit was still there, and the students that kind of met in the middle. So over the large sum of everyone's actions, it produced almost always the same bell curve. So from his side, he's like, there's no alarm side. The upper departments of the university there's no alarm bells there. So why would he change? Why would someone who's been doing the same thing for the last 40 years wake up today? And that's and my point in bringing this back to the market. The people that run the market, so be it, if you've made money in a certain way for 30 years, let's say you're 55 now, you have kids, you have grandchildren maybe, you've lived your life. Are you really waking up at 55 after 30 years of trading and saying, I'd love to backtest a new way of trading? Like, is that really going to be your predominant thought process when you're financially well off, you've built generational wealth, you have 26 income streams, like remember, because these are people that are running the market, so finances are good. And if there's no reason to change your action, why would you? And I think that's the poor bet.
Would that imply that you don't think the market has really or will not really change? It's more us is the problem, not the market itself.
Take COVID, right? Did human psychology change since COVID? Right? COVID was so phenomenal in it because you kind of got a split in humanity. You have to be like, hey, this is the time for me. Like, especially when we were all in lockdown, I can hustle, I can grow. The other half was like, hey, vacation, I'll wait this out. Right? And as we go in after, and as we see with controversy, as we see with things, memories are short. Right? Meaning in the sense of, again, in the crypto market and many things, to be honest, things have crashed so many times and they come back. And yet people don't remember it. They act every single time like it's a new thing. You could see it with the fall of prop firms. They'll just jump to the next one. Yeah. They won't look at the data of like, and then the next prop firm say, hey, no, we're good. And everyone's like, okay, great. Right? Like, you can see people don't understand how these evaluations work because whatever was the number 1, 2, or like 3 changes over the years. And then we just carry on.
And the same blueprints, yeah.
And then it falls, and then they're like, hey, we couldn't balance the books. And everyone's like, what? No way. And you're like, well, and it's funny, it's a race to the bottom, right? You've allowed, like, this is obviously more of 2 weeks ago at the time of this podcast, but it's that side of you allow discounts, like heavy discounts, like 40% off or whatever, 90%, 95%, 100% profit splits.
It's such a fragile model. And as you said, it's a price war.
Yeah.
And there's no benefit in being second cheapest. So they're just trying to undercut each other. And they're also trying to make more and more favorable conditions for the trader to attract them. But then you got to realize the intrinsic way it works is you need people to fail for it to work. So then if you make it cheaper and then your revenue is less and you make it too easy to pass, it's going to collapse.
It collapses.
And
it's a house of
I
cards.
spoke to the founders of Alpha Capital, and because they have predominantly their space is the brokerage space, and prop firm became a secondary thing. They have experience in the city and so forth. I asked them, like, what are you doing to hedge that situation of not just booking everyone? And they were looking to use the data, reverse trade it or sell the data or whatever. They were just looking at all these options. And they were just basically saying, no one's going to take the data. And it's just garbage data. I was like, yeah, but if you've got 90% of people losing, then you just do the opposite. In theory, they were like, yes, the problem is not that. Because that's what brokers do. Brokers will sell their data. Brokers will reverse engineer the data. And they'll make another revenue stream out of the data. And I was like, why can't you just do that in the prop model? And they were like, because the psychology is not there.
The psychology is
not
like,
there,
people
but
just
also randomly,
the data is not also there in the sense of like how much data can you really extract?
No, if
from
you have
the
100,
30 days?
if you have 100,000 traders, and I mean not an individual trader because they come and go, but as a whole, there's a lot of data there.
Yeah,
But
yeah.
the problem was, let's say someone's trading very strict to the funded stage. Then they get funded, and then, as you said, they got to make a payout. They just change everything. And they're like, the issue of people blowing their accounts is not the strategy. It's not even the max daily drawdown. It was like the difference between the evaluation and funded is people just want to hit a home run.
But
and that's
it's also
the main
people
reason.
treating it as like,
It's not real money.
you know,
So-
one of the mistakes I made, like I've never lost a funded account, funny enough, and I would argue because I said something almost the opposite on my Riz podcast, but I'd almost argue I was too professional for the scene, right?
What
And
do
I
you mean
seen
by
that in
that?
the sense of I traded as if they were going to copy trades. Right. So this is like 2-3 years ago, right? So I was like, so when I'd go and draw down, I'd take the higher way up, right? Like I would reduce risk, build my buffer,
Okay.
get back up, and I'd be like, if it took me 2-3 months to get out of drawdown, it took 2-3-4 months to get out of drawdown. So as a side effect, I've never lost a funded account. But on the other side, I've left money on the table because if they're not copying anything and someone else is just kind of coming in 3% risk and they're almost using the evaluations.
Why were you doing that? Were you doing that because it's someone's money, or it was more for yourself?
I looked at it as the idea of they're probably looking for people to A-book. What
Okay.
characteristics would an A-book trader have?
Okay.
Probably not extreme sums of drawdown.
Yes.
Consistency in the long term. You're going to need a sample size of trades, right? Like it's all these variables that you would measure someone. And I looked, and I guess where I would say I was lucky to, like my very first investment was an investor. And so when you're pitching to it, you don't tell them, hey, just give me money and then we'll hope for the best. And oh, I'm 10% drawdown. Yo, can you just top it up and reset? Like it doesn't work like that, right? So you almost got, and if you take your average person, like I don't know about yourself, but like me back then, I didn't know that many wealthy people. I didn't have these options of like, all right, I know 10,000 people. It's like I only really knew like 1 or 2 wealthy people and they knew each other. So chances are if I messed it up, they're gonna be like, hey, he's shit, like, and that's it. So you really only had one chance to scale up. Whereas with prop firms, you fail your FTMO account,
Reset.
you get an email. That's it. Oh, sorry, here's a discount code. Start again. So they're partly the problem that they're encouraging it. Like, hey, just go at it again. Maybe it was a bad run. You have
Yeah, so in this, you could also like get caught up into the victim mentality of like, oh, this is not real and whatever, and oh, but it's not realistic conditions. And to the point of Alpha Capital, they're not, or no one in prop firm can actually sell the data and use that as a revenue stream. And believe me, most of them have tried. Is because no one wants to buy it because you can't dictate when someone's going to wake up and decide to gamble it. But if it was someone's real
there's
money,
no vetting on the person.
if it's real money, no one's
Like
going to do
that's
that.
why like we have our own in-house, right, that Mark set up over years. I think that's been the cool part because as it's scaling up, we look at a lot of the data. We actually know how people are trading. We know the individual. So
Okay.
it takes
Remove that element of random gambler
that's
wake
it,
up.
right?
Yeah.
Like, sure, does the gambling element exist at the very start of the assessment? Perhaps, but that's at the lowest level that it doesn't manage the biggest thing that firms, hedge funds that they try to build is diversification, right? Diversification is very hard to do from both a technical point of view, but also an identity point of view, like meaning the person. So when you're, again, a whatever prop firm, and you don't know anyone, like they're all just numbers on a screen. You have no idea of personality, backgrounds, experiences. Okay, that's its own sequence of probabilities. There's the sense of how serious they take it, right? Again, if you blew your account today, just buy another one, whatever. That's hurting the firm, like their model to build upon you.
Yes,
Whereas what we've been able to kind of do is when we understand, all right, we know what most people are intrinsically looking at. It would be call it like the risk manager's job, right? You have the whole fund. You have to set the parameters now of what do you copy at what level? Do you add more risk to certain persons?
to a book, you mean?
Yeah, well, it's in our case because like Mark secured real capital. It took him years to do it, but that's part of like doing things at an older age. I guess you build it correctly rather than a white label in that way, right? It's that side of you want to increase profitability in the sense of in a picture perfect world, you'd risk $1, you'd make 100 million. That would be like you'd be a god, right? Now the reality is it's not always the same, meaning you can have a negative RR with people and you see that, right? Someone could be like, hey, if I took Waqar, I made $3 million this year. You're like, wow, that's incredible. Well, it depends on how much I traded, how much I risked, how much, all these things. If I made $3 million from 100K, incredible. Way more than incredible. If I made $3 million from a $500 million account, kind of dog shit, right? So there's the side of then you look at your traders and you realize, all right, who has done well over a longer period of time? We could start allocating to those people more money because that trust is literally there, right? As you've seen them over, like you've seen them at the 100K account, you've seen them at the 200K account, you've seen them at whatever. Then at the level of what actually happens is, let's just say, because the market is going to predominantly go in a certain direction more than others. That's the whole point of analysis. So if I say, hey, I see the DXY being predominantly short over the next 3 weeks, the risk parameters have to shift to a euro dollar long, for instance, like a more strength in that way or a dollar weakness. And then that means anyone who's taking on the opposite side, because it's not just, oh, I'll just allow them to take whatever they want, because in theory, and that's what you're saying about, oh, just take the opposite trade. The market doesn't necessarily, it's not that you're wrong, then the other side is right. You know how the market can go like whip both ways, and all of a sudden, if you're whipped out on both sides of it, everyone's wrong, and the fund is even more wrong because it was the risk taken on both sides. But then there's the payout side, meaning, okay, you took the 1% loss on this side, but then you took a +1 on this side, but then there's the payout commission. So that's eating away at the profit. So you actually have a negative risk to reward on literally a +1, -1, but because of the payouts and commissions and blah, 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 it's now still negative. These are the things that people are not considering in balancing all these books, right? And then balancing the long-term holds and stuff. And it's so hard. Like, that's why for years, like when I studied, I was like, man, how did they do it? Like, it made more sense when it was FTMO and my Forex funds, because they were like first to the scene. So there was a market share that they just made so much from it. And it actually came out in my Forex funds' court case that their A-book was negative. And that's what kind of showed it to me. I was like...
Well, the reality is there's not enough... And I want to get into how your guys' fund operates, because in an idealistic world, you find the best traders, double down on them and give them the most capital, A-book them and all of that. But it's not being a true model in the industry. And the reason is because I think it's just a lack of actual competence. Where when I speak to the founders of various prop firms, I ask them, how many of your traders make it to the 5th payout? How many of them have actually made profit over time? So we're like, Waqar, it's less than a decimal percentage. And if you have 100,000 traders and maybe 5 of them you can trust, you can't build a fund like that. When you have the revenue coming in the way that it is, it's like it doesn't make sense for them to do it, because they're a business at the end of the day. And therefore it becomes a case of, okay, you just got to play with the evaluation fees to the payouts and pocket the difference, which is now dangerous, because now the revenue is getting less and less for these firms, because they're trying to give discounts and they're also making too favorable conditions. So then too many people make payouts, and then a lot of these firms collapse, which has happened. So what I found is, well, if I'm making a decision-making process on what firm I should be working with, you don't look at the price, because the price is so irrelevant and people get caught up in it. In the case of, if I could save $50 on an evaluation, but my objective is to make a payout, and this firm over here can give me a 90-10 split, and the cheaper one of $50 off can give me 70-30, that $50 on a 20% difference in payout, well, that's going to be thousands of dollars if it goes to plan. But people focus on the wrong thing. And I think the thing to focus on is, what is their profit margin look like? And if that's you A-book them, if that's they're making other revenue streams, if that, because they've got other things going on, you need a stable prop firm, because you've invested money and time and you want your payouts. So when you look at these firms that are 6 months, started to go 6 months and they're flimsy and whatever, that's not a good bet. But if you're trading with an FTMO that's been around for God knows how many years, safe bet. If you're trading with a firm that has their own brokerage, that is regulated, good founders, and that have their own tech, that makes way more sense than a firm that's just got a cheaper price.
And they have to pay out.
They outsource the tech, they outsource their broker fees, all of this, because it's a flimsy model. So I think that's the decision-making process. But then it does... well, it's interesting. I want to get into yours. Is like, okay, you're not focusing on that element. You're focusing on, let's just A-book the right people and go for real capital. And that's the more... Well, that's the approach you want to take.
You're A-booked because you pay your drawdown. So there's no reason not to. It's the so like we're not an evaluation firm that way. Like even in like.
So what would you say are the primary? How many revenue streams would there be for this fund? Your does it have a name?
FFX. I think
FFX.
that's the legal name. Yeah.
Okay. What would be for FFX? What is the revenue models?
So it follows similar in the sense of like you have to hit a 7% profit target and all that, but we have a 30 minimum trading days, right? And partly in that is to actually collect the data, right? And that's the side where a lot of people don't actually find it attractive. I think even in being a Falcon student, for the longest time, we've had a 6-month requirement for you to like apply to the fund, because we don't want like shit data. You know what I mean? Like that's the side that's immediate right away. And then if you do the math, because I think the biggest account we have 15K, nobody wants to start on 15K.
Okay, got you, yeah.
But it's you pass, it becomes 4 times, and then it doubles every 10%, right? Okay. So the higher up you get, awesome. But the starting factor, when you're comparing a 15K account to a 400K account, it's not alluring at all. And, I have to be 6 months in this, and I have to do that. Yeah, because we actually want to trust you, because at some point to give you more money, that means we're onboarding the risk.
Do you let the trader know how much capital they're actually trading? Meaning the psychology burden is still upon them?
Well, they know. They have their accounts, right? Like
it's not a case of like you give them a 100K account, but the investors really like it, and then you might scale it up in the back end to more if the investor wants to.
We're not fully at that point yet, right? I would say maybe half a year out to a year from that point, like where a lot of the numbers, because it's like all those things, you start it slow, and at first it feels like whatever, right? But then as you get to the point now where you're like, okay, you're hitting quite a few people on the 6-figure accounts and whatever, and then they have their adjustment period, and then you're watching that time. So it's actually very cool because you're teaching them at the same time, but then you're watching how they're responding on the data, and then you're like, okay, cool. But that intimacy is what allows us to give the bespokeness to the trader, right? So it's not just this marketing gimmick of like, oh, we have your best interest at heart. It's like, we actually literally know you, because by the time you get this far into the stream, we would have talked to you at least multiple times over months and whatever, right? Versus when, you know, random X firm tells you, hey, we have your best interest at heart. It's like, why would you? No, but like, and I'm not even saying that pessimistically. When whatever firm says, hey, man, I want to give you the best.
So direct conflict of interest.
You know what I mean? It's a of course it's a conflict of interest, right? Versus it's not a conflict of interest for us, because until like it does at the later stage of, maybe not conflict of interest, but like as you get better, we're onboarding more risk at that point. But you would have earned the trust by that point.
It's not as much of a risk.
But that's it.
What about the idea of everyone's kind of it's not open to the public, so it's your members, it's the people you know and trust, and people have proven themselves, which makes a lot of sense to me. Do you not feel, or do the investors not feel, that there's an overexposure on one strategy, because you're all more or less trading the same way?
That's why we are going to open up about, I think, 20% of it to the public. Okay. That's where the rough math seems to kind of show it, right? But even within that, we'll still be very cautious within it. Like, this is not going to be one of those things that you'll ever see. We have tens of thousands of traders. We're not interested in that. You know, it's like, I know Mark's goal is to get the fund to 100 million. Okay. You know, and it's like, once you get to that point, I think at peak the rules are 4 million max per person, right? Okay. Now, that's in a perfect case scenario where everybody hits a perfect 4 million. Well and truly, a lot of people along the way might hit like 500k and they're good with it, right? Now, the cool part that comes with it is almost like we can reinstate accounts, right? And that's subjective, obviously, to how you lost your account, what happened, things like that. Meaning, if we know a really good trader happened and they weren't doing anything particularly bad, and let's say the market flash crashed, we'd be like, they've actually never messed up. Yeah. We're like, hey, we can reinstate this. Versus, I don't think other firms would do that for you. Like, I'm not trying to throw shots, but that's not their model. So if you get hit by something unlucky, they're just like, and you see this with the new rules, CPI, what most of them have said, they didn't actually stop your account from trading CPI. They let you trade it. If it loses, those losses are yours. But if you get profit, oh, sorry, they don't count. So why not just block trading if it really was just not allowed, right?
What is your thoughts on, like, the game is the game, and meaning to say, like,
I know
boil it down to, we came here to make money, and a lot of people get into like self-help jerking off, and they want to go into all of that. Other people get too lost in the theory of like ICT this and that, but then they're just not making money, but they're really good at theory. What does that even matter? And they're just focused on being right. And other people are just here to make money. They remember that. And just from experience of who I've spoke to on the show, I've had a bunch of guys who have made a lot of money from prop firms, be it Kyle, who's made millions, Andrew NFX, he's done $1 million, Pascal, who's done like 2 or 3 million. And their philosophy was, okay, well, we know this is a fake environment, we know this is a simulated environment, and they won't trade their personal capital like this, but as long as they're within the rules of the prop firms that they allow, why not just play to the system and play the game? And even if it's not the most data savvy, even if it's not the most sustainable, they made the millions, and the guys that are trying to be righteous, well, they're not passing them and they're not making the money. And for me, it's like, well, the game's the game. Would you rather be right or make money? And that's what I'm seeing. And when I speak to these guys, they're like, when I do a challenge, I'm not going to spend 3 months on the challenge. I'll try and do it in a day or two, because if I fail, I just pay another couple $100 and I go again, and I know I'll get funded, and time is more important than doing it consistently. But then when you get to the funded account, okay, let's be a bit more sensible. Let's not do the max daily drawdown in the trade. But the goal is to make money, so they're not going for 0.5%, 1%, 3% months. They're going for, let me make a bit of money and play the game. But they will trade completely different on a personal account. What is your thoughts on that?
I like, that's the part I was saying earlier, where I've like, that's probably the mistake that I've made, right? Like, I've made 6 figures in payouts and stuff, right? But that number could have been probably closer to 7 now, had I like upped my risk parameters and not been as professional I was. You know what I mean? Like, that was the side where I guess I
regret that, knowing that you're going into a more A-book fund approach.
You know, I'm not a person that regrets anything. That's the thing. So when you tell me would I do it again the same way I would have? No, I wouldn't. But that's not necessarily a regret.
It's not a burden. Yes, it's not
you know
a burden.
What I mean?
Yes,
like,
yes.
Because I also, something like money, you can catch it up very quickly. And what I mean by that is, like, look, 3 years from now, I could make, let's just say I make $5 million, $10 million, $100 million in a year. That's not going to be linear to the path.
Trading is always an exponential thing.
That's
with
it.
Capital,
like, you can kind of do something wrong, miss out, to be like, oh man, I could have caught this for that and this, and I'd have more capital here, and you can play the simulation whichever way you want. But it can make its time come back, right? Whereas I kind of look at it more as like the life lessons and the longevity in which you're going to kind of do something, right? Meaning, I taught myself, one of the cool parts is, I'm really good at getting out of drawdown. You know what I mean? Like, I'm completely stable. I'm not, I don't...
Why do you think you're good at that, getting out of drawdown? Like, what are you measuring to say that?
I've never lost a funded account. You know what I mean? Like, so...
And what do you do to be able to do that and say that others can't? Because as you said, in isolation, in a bubble, you just say, oh, do X, Y, Z. But X, Y, Z is not usually held.
I've built my life in a way that is not, one, dependent on any particular account. Two, I can wait it out. Meaning, and big part for a lot of people in their models is they get in drawdown, they want to get out of drawdown now. Now, let's just say you happen, and this is a real thing, you go into shit market conditions, and there's no trade for 2 weeks. Can you really wait the 2 weeks? Versus I can look at something that's, higher in risk and be like, okay, I'll take this on this account that's in positive and whatever, no problem. This one that's in drawdown needs to wait a bit more. Or I can, even the idea of taking certain profits sometimes along the way, meaning if I'm, let's just say -5, a trade's running 3%, I might say, you know what, I'm going to take the +3 right now. Then I see a lot of people, I see this so much on Twitter. Someone's -9 to passing in the same trade. And it's almost used as like a flex. And I'm like, that's so interesting.
So this is something that I modeled on an Excel spreadsheet. I was like, obviously, and I said it very clearly so people just don't get it wrong, just do this in the funded stage. Like, what is the objective? Is to get funded, to get the capital, and then trade it sensibly. But what is the benefit? Really, like, what is the benefit of spending 4 months doing it sustainably in a simulated environment to get funded? When in theory, if you just play the numbers, you play the limitations they give, why not get it?
But most people can't afford unlimited challenges, and I think that's where the logic fails, because the greed will kick in. Meaning, if you have $1,000 to pay for an assessment, you should actually be buying the 10 or 25K account. But the $1,000, I think on one of the firms was 400K at the time. You're really gonna pick a 10 or 20K account because you're running the 2%, and you're like, oh, I just need to pass, and I make 2%. I'm making 8K. That's 8 times my investment and whatever. That greed kicks in. That whatever, right? Yes. And that's where the side of the advice that comes from like Andrew and those, right? I don't disagree with it at our level. Right, like, and that's the side I was like, you know what, like, that's what I could have done better from that point of view. Your average Joe, they can't afford to just buy assessments in that way, and with every failed assessment, they're giving themselves more negative feedback, more like negative price action. That
Limiting
way of like,
beliefs,
that's it. And now it's like, look, this is not meant to happen. And when it finally happens that they do get funded, they blow it because that anxiety is going to come in of like, oh, I've never actually made it this far. I've only really failed up until this point. Is it a fluke? The second you're introducing fluke into your doubt. So you see how there's so many traps that's intrinsically come. And I think for myself was I never wanted to level down in life, in the sense of that to me was more important, right?
You don't want to set the bar too high in terms of I have this much funding.
It's I'll say it in the sense of like, I'm an incredibly ambitious dude.
Yes.
But like, I remember when groceries were not a thing for me anymore. Like, I mean this most humbly, I don't know the prices of most things in the supermarket. Because it's, how much is it really going to be? There's no chance I'm going to buy some meat and whatever, and it's going to come to $12,000, right? So even during the oil surge, right, like I buy the most premium gas or whatever, and everyone's like, oh my God, it's unaffordable. And I remember I was at the, like, what do you call it? Like the petrol thing where it shows, right? And I saw a lot of like $20 for people. I was like, oh shit, like people are only gassing up to 20 and stopping. I was still doing like full tank. And I'm not saying this as flex, I'm saying it as a point of, I got myself to a point where this became basic to me that I always gas up fully. I can always buy at the grocery store. I remember telling my, because I take care of my grandmother, and she doesn't come from like the wealthiest of backgrounds, and I took her once, I was like, buy whatever you want. She's like, no, it's expensive, right? I was like, it's okay, like it's fine. But because she spent most of her life like counting the numbers, she still can't. I'm like, it's been years now that I'm like, grandma, like buy whatever. If you want to have filet mignon breakfast, lunch and dinner, don't recommend it maybe health wise, but we can do it. You know what I mean? Like, it's fine. And that was the same idea for myself, was even in going full-time, even as scaling up, even on these things, I never wanted to be at a level once where I'm like, okay, I can do these things, and now I can't do it anymore because I'm in drawdown. It's like, no, I want, regardless of my account status, hey, if I want to go out tonight, and that becomes kind of a thing, even when I'm in deep drawdown, I still go out to the same restaurants that I go to, I still spend the same amount of money. I'd actually argue sometimes when I'm in drawdown, I spend more money. You know what I mean? Partly because my account's not dictating my performance and my psychology. I can actually understand it at its truest level, that it's a sequence. So I think that becomes easy for me to get out of drawdown. And I didn't gamify it at the wrong point in time. Like in teaching that now, and that kind of teaches it, right? Whereas I think for a lot of people, they gamified it right away. And I do have a massive like video game history, so I understand the psychology there, but I understand how that psychology bleeds into other things. So do I regret it? Not, maybe from just this like because I do think the evaluation models are going to change in the near future. I don't think they're going to be as easy as they used to be, to a degree, or as kind, maybe is the better word. But when you're skilled all around and you know what you're doing, it doesn't matter.
That's the paramount thing. Yes, having the skill set. You know, when I've spoken on these kind of topics that we are, my position has been trading is not a beginner friendly endeavor for wealth generation, and I kind of put it in milestones where if you want to go from you've got $0 in the bank account or debt and you want to get to a 10k net worth, trading's not your vehicle because the percentile of success is so low, and more importantly, how good you have to be to make it work out. Meaning to say, I give the example of sales. If you can just get good at sales, how long is that really going to take? couple months to
Yeah.
get the basics. Will you be able to land a job if you're half decent? Yes. Will you be able to close deals? 100%, because some people don't need to be convinced. Some people are ready to buy and you'll still
And
get
you
a commission.
just did right there, yeah.
So the guarantee of you making 10k in sales is there. You just got to do it for long enough. And if you're 50% of the way there, of a professional, if you're 80% of the way there, you'll still make money, you'll still close deals. But if you're 50% of the way there as a trader, you will not. If you're 80% of the way, you will not. So why would, as a beginner, to get a 10k net worth, would you start at trading, no matter how the perceived upside is so high, and the barrier to entry is so low? As we said, it looks like the easier thing to do, but it's not the sensible thing to do. So I've kind of outlined it previously of the roadmap to wealth. And I've also said, if you want to get to, let's say, a $10-50 million net worth, trading is a good one, but I wouldn't say it's the best one.
Yeah.
Because there's also certain bottlenecks, limitations, psychology, and these things. Whereas if you just have a cash flow business, it's probably easier to go from the 5 to 10 mil range in a cash flow business as opposed to trading. I would argue, if you want to get to $100 million, trading would be harder than starting a SaaS and going for an
instance,
exit.
yeah, okay,
Okay,
yeah.
It's a skill thing, and you got to have money to invest in a team and so forth.
And
There's other
demand and all that, sure.
There's other things, of course, but like objectively, I would say that is easier. So when I've kind of mapped out for myself and what I've spoken about of a life plan to,
Certain net worths,
stages, trading is not the first one.
Yeah.
And the reason I say that is because not only the skill gap and not only all the other things, it's also a case of anchors you have in your life. And as you're basically alluding to, if you're focused about how much things cost at the grocery store and these kind of things, it's going to bleed into your trading. And you don't want to have these anchors because you're going to be trading with an outcome, which is what we've said. You're going to be desperate for time, and you're going to be
want
desperate
something to
for a
happen.
payout. Whereas if you just have cash stability,
Well, inherently, why do the rich get richer? It's not because they're super smart majority of the time.
yeah.
And I'm sure you'll actually agree with this. And it was probably one of the more paradigm shifts I had as I got like wealthier and I met more people. Not a shot at anyone listening to this, but they weren't the level of smart I thought they would be, and not a shot.
I know exactly what you're saying.
I was like, yo,
I've met enough
you know what I mean?
people
And
that
I
are
was
doing
like,
well. I'm like, you're not that smart and you're not that hardworking. I'll be
Yeah,
honest.
I was like,
I know a lot more
honestly,
people that
like-
work harder than you.
Yeah.
But you just use leverage and opportunity really
at
well
the right moment,
and I think
because
that's
you can
more
wait for
important,
it, right?
Yeah.
Like it's the same thing. Again, I've leaned on this example a bit but like I'd read this in a book once. I don't remember which one, but it was honestly probably one of the sentences that really did change my life. Was something along the lines of like, you only need one bull run to like change your life. The trick to it is putting enough in and surviving the bull run. Because the bull run's not just A to B. It could be A to B from time, and then A to B of like how much have you put in, and then the pullbacks along the way.
Yeah.
And can you not pull out for a shit amount? Meaning like if you put in 10k and it's running 22, it's $12,000 profit. It's a lot in terms of someone who has 10k and whatever, right? But on the other side, it's not generational wealth changing. It's not one of those things. So it's like, okay, I have to have a bit more than that. And then in that moment, when you realize, and you said this early in the pod, which I fully agree with, the more capital you have, the less you need. Meaning like, Mark had actually said this once. I was actually being kind of like egotistical or something. He did call me out, and I really appreciate it to this day, because I'm a huge coffee drinker, like a general addict, right? And he's like, Abdu, you will never forget the price of a cup of coffee. And I was like, that's true. Like, I didn't understand that in the moment, but I was like, what does he mean by that, right? And because I was talking, I'd made a lot of money and whatever, and I was like, oh, I was just being kind of like dickish. And if someone right now were to try to sell me a coffee and they were like $212, I can afford to pay it. But why the hell would I pay $212 for a coffee? I know the valuation of a coffee is somewhere between $2 to $9. Maybe if we're at like the Ritz, $12, whatever. But even at the Ritz, I'd be like, why are you charging $65 for filtered coffee? You can't. So you still know the value of the dollar in that way, right? And that actually kind of really stuck with me, and it really did humble me in that moment, because I was like, it's true. As you scale up in net worth and stuff, yes, different things change and whatever, but you still understand what everything is supposed to be to a certain degree, right?
I would argue that life setup is more important than the ins and outs of psychology that we have divulged in. The reason I say that is because if you can absolve the externals, let's say you're not in debt, let's say you have a consistent income, let's say you have safeties in your life, you have a fallback that if my trading goes wrong for 6 months, I can still afford rent and these kind of things. That is going to be more paramount than a real strong technical edge. It's your life setup, which is why I've also said trade is not a beginner thing, and I'd rather you have a stable job, cash in the bank, and a little bit of stability, and then get into trading as an 18-year-old, these kind of things. What I want to do now, because we've spent majority of the episode on psychology related things, and I know you're not a one-dimensional person. I want to get into a little bit on technicals.
Sure.
And the reason I want to take this route that I'm going to with you is because I can tell you have depth of knowledge, and we can take the conversation in a nice area, which is not always the case. I want to start off so we can get a macro. Is what would you say are the 3 most important technical confluences or factors that you put weight on?
So we trade market structure predominantly, right? And it's more, I think, I wouldn't use the way we trade as strategy. It's never really resonated with me in that way, because strategy tends to mean, like jab, jab, right hook or whatever. It's something you're going to come in, you've studied your opponent, you know their weakness, you're going to act in that way. We're more akin to, if you take soccer, learn how to pass, how to lob, how to shoot, and it's your job to figure out when to do which.
Nice.
Right?
Yes,
it's
yes.
more akin to that. And it's how well do you know each one? Meaning, like, I could shoot the ball from half field, and in some situations it might score. Is that statistically the right thing to do? Again, in some situations, I think there was a game recently, like 2 weeks ago, or I think it was Man United versus Liverpool, where the goalkeeper was really out, and that one, right? And I remember in the moment we were watching, I was like, this is a disaster, right? But statistically speaking, that shot is terrible. But in that moment, he realized, oh, we don't need to run it up. Yes. The goalkeeper was mad out. They got it, whatever, right? So we trade more in that way, which is, we have something called nature of price, which is what is price like showing you, right? That's more along the lines of, are we in impulsive ways? Is it corrective? Is it exhaustive? Is it in a run of momentum? Little things obviously as like time of day kind of come into factor, like sessions and stuff, and it's that idea of, for myself, I'm always looking at it from the point of view of what can I get away with? Right? That's kind of the lens.
What can I get away with? What does that mean?
So what can I get away with in the sense, like, I guess growing up, I've always been a bit of a rule breaker. But rules only matter in terms of when you get caught. And the question is what rules are you going to get caught for? Meaning, I don't know, something like murder, they're probably going to go after you for that. Something small, who really cares?
You want to say it on camera?
Yeah. I'm like, right?
I know what you mean, though. I know what you mean.
But but you look at it, right? You if you take 2 examples of the same thing, I've used this example before, but it really displays it well. If it's a Tuesday night and a Friday night, same car, same highway, same time of night, and you're driving double the speed limit, doing it on a Tuesday, you're statistically way more likely not to get caught versus the Friday, because Fridays they're looking for DUIs and drunk drivers. Versus Tuesday night at 2 a.m. Why is a cop just waiting there with his radar being like, oh, I think this guy's going to come, like whatever. So it's more of what can I get away with? Meaning if you want to speed, you got to do it on the time you're not going to get caught. Speeding on a Friday night, intrinsically really stupid. It's not safe. And I say that both from your own point of view, but also there's probably other people on the road that are drinking that they won't respond well to you driving. Rage could be higher under like the enforcement of alcohol. So you're actually taking, even if you're perfectly controlled, you're confident behind the wheel, that driver can kind of take you out. On a Tuesday, it's very unlikely to have a road filled with alcohol-induced people, right? Same thing with trading. It's a big thing along times is it's less like, obviously you trade the main 2 things, which is reversal and continuation. So no matter strategy that you look at, it comes down to the same thing in the end. Maybe that's why I've never been a huge fan of the different words used along the way, because it's fun. Like the market can only either continue in its direction or reverse. There's no other option along the way, right? Like that's why I think I found a lot of it a bit more comedic. So in my case, I try to define of like, okay, right now are we continuing or reversing? Do I have the market structure to prove that? And then the big part for me is 2 things. Where can I position my stop loss? Meaning I like to be really wrong on my trades, not partially wrong, right? So what you were talking about before about a liquidity sweep, for instance, a lot of times a liquidity sweep is just a poor position of a stop loss, right? You can be maybe way too zoomed in, and this kind of happens to a degree with the lower time frames you go. It's almost overvaluing every single pip, meaning you put a 2 pip stop loss. Again, I think the attractive for a lot of people with the 2 to 5 pip stop loss is the high risk to reward, right? It's less to do with the precision of the information versus, so there's a trade-off within there. Versus myself, I'm less bothered about getting the maximum risk to reward. And maybe because the way I look at it is like, you can have the destination, if you want to take that logic of, you can have the high risk way of getting there of like, you could not be there, and then suddenly you're there and you're like, wow, that was amazing because it's such an incredible high. I'm kind of somewhere in the middle. I'm not going to take also the slow path. Like I'm not an S&P boomer. I'm like, oh, make 3% a year, 10, whatever. And I'll try to up the numbers, obviously. But there's a degree of what numbers do I need to get it to? So in my case, it could be like the risk to reward range. So I usually aim for at least a 3 to 1, and partly because with 3 to 1, I'm almost always going to be locking in some degree of profit, so to speak, versus a 1 to 1. A lot of time, like I don't like 1 to 1s because if you're taking profit at 1 to 1, you have to have like a 70-80% strike rate, and it becomes quite a battle to go with, right? I like to have that 45 to 60-ish% strike rate because I know my sweet spot of trades per month is somewhere in that 8 to 12 range. And it's cool because we're not like directly session based that we have to sit down. Like when you know what you're doing, it's minutes a day, so to speak. You know what I mean? You look around and all the process is done in your prep work, and then it's just alerts, right? So it's super cool because when you're at the scale side of things, yes, you literally go snowboarding and you pull out your phone, you take the trade, and it really is that trader lifestyle at that point. up until that point, it's most definitely not that, right? So for myself, I'm always looking at like, okay, let's say the market's predominant continuation, but there is a short-term counter trend reversal. If that reversal per my entry is like a 7 to 1, I will actually take that because 7 to 1 is incredibly valuable, but I also manage it more aggressively at that point, because why am I expecting the market to reverse more when I'm already like contrary to the opinion, versus in a continuation side of things, because we trade a predominantly multi-time frame kind of thing. That's the side of, in the more short term, just because of prop firm rules and the geopolitical events, it has kind of taken a bit of a hit on like long-term holds, I would say. I'm speaking this on behalf of like the prop firm side of things. Like, I think that risk is, I know there are swing traders that kill it. There's not a shot at them. There's nothing to do with it. It's just, I think the environment's not the best for it, with a lot of gappings or potential gappings rather, and a lot of those things. So I focus on what can I get away with, and can I put my stop loss in being wrong? Meaning, if when you're taking out for a trade, a lot of the times people say, oh, my trade took me out and then it went. Instead of taking that against you as the market, like pinpointing you, like, hey, Waqar, I'm taking you out today or whatever, maybe realize, why was it able to wick to that area? Meaning, so what swing traders get right, so to speak, is they have massive stop losses. So they're almost never wrong. But if you take that logic and you kind of make it a bit more precise onto the lower time frame, there is a sweet spot within there that you can actually not sacrifice risk to reward. Like, sure, you're not going to hit a 40 to 1, I'll be honest, you won't. But you can hit like 6 to 1, 7 to 1, 10 to 1 on the somewhat free. That's it. And it's like, when you realize if you have enough capital and you're making 5% a month more, it's a joke. You're living a full life, right?
What we're getting into, and I've spoken to about it with a few guests, and I think it's important. The analogy I give, maybe you've heard it, maybe you've not, is those people at the circus that spin plates. And the idea being, and the problem with traders is we focus on one plate. We focus on spinning that plate of risk to reward. I want to get that 40 to 1. And then they'll sacrifice the other plates and their win rate is in the floor. So the idea of a trader is, let's not focus on one plate, let's balance all of our plates. Let's spin them all. And then when you see something is about to fall, you spin that plate a little bit more. So what I've done for myself, and I want to ask you, is I have the numbers for all of my thing, and I know my acceptable ranges. So I know that I shouldn't have variability in anything. Meaning, say, one day I shouldn't be trading Asia session, the next day I should be trading in London.
Controlled volume.
I shouldn't be trading GJ one day and then CAD JPY the other day. I should be trading consistent pairs, consistent trade frequency. I should be trading, everything should be within buffers. And then I have my mental alarm bells if something's deviating. So I know that my win rate, I like to, by design, keep it at a specific range. Mine is 45 to 55%. Now, I used to believe that win rate was a performance metric. Like, when you go to the gym, the stronger... You
sacrifice money the higher you go.
Yeah, so it's like, it's not a case of the better trader has the better win rate. No, it's a controlled variable. So it's not a bench press, the stronger you are, the heavier you lift. No, win rate, you determine. If I wanted to have an 80% win rate, I could. I just have to be very selective. The trade is not going to come around every day, but I could do it. And if I want to have a 20% win rate, well, I could also do that. So when I know that it's in my control, I therefore optimize it to where I want it to be. And I have my buffer. So 45 to 55 is where I've kept it. And I know that if I'm going to a losing period and my win rate is at the 35%, I know that, okay, I'm not in my buffer. What do I do then? I don't take my counter trend setups and other hedges and re-entries. I stick to my prime setups, bringing my win rate back up. Now, if my win rate is getting to, let's say, 60-70%, that's a good thing. But I know that I can now start taking a little bit more aggressive, a little bit more aggressive setups, and now I can take those counter trend trades, and I will bring my win rate down as a result of it. But then that's not the only plate I'm spinning. Now the risk reward of taking those counter trend setups, trade frequency, all of these things come into play. What would you say are the acceptable metrics for you, and what do you target? Like, what do you aim for in terms of trade frequency, trade duration, time of day, win rates, risk reward, all of your controllables? Where do you like to have them?
So to half answer your question there, the one thing I kind of aim based on my own data is I try to target an 80%. Funny enough, Parkinson's law, right? In that way, is it Parkinson's or Zipf's law? I always confuse the names, but the one where it's like 80% of your result. Sorry, 80% of your results will come from 20% of the things, right? 20, yes. So that always stuck with me, because the more I back tested that, and I'm not even just talking like the market, I mean like just life, and I looked at it, I was like, oh shit, like
it's always true.
It's always true. It's one of those weird like mysteries of the world, right? And I was like, well, why would this be different, right? So then I started to look at my trading, and I was like, one of the obsessions that I see with, like, let's just say ICT or whatever, it's this getting in on the pinpoint part of the market turning.
Precision, yeah.
I actually gave that up right away, and someone might say, wow, what are like idiots, like you're stupid to do that. I just looked at the chances of like, what is the likelihood over a long period of time that I'm going to statistically know the exact moment the market turns around? Because what I realized in a lot of my trades, I remember this was a while, and this is the pattern behavior you pick up when you study your shit. I remember it was a while, I was tagged in, just took me out, dropped, and then, over like 25 trades, I look back and I'm like, man, this happened like 8 times. 8 times is a lot. So either A, the market knows that I'm doing this and it's specifically targeting me, or B, something is wrong somewhere, but it can be solved by just having 5 more pips stop loss, for instance. So I did that time. I had no idea why it was happening, but I looked at my data and I was like, wait, if I added 5 pips to my stop loss on all of these trades, would I have stayed in?
You're less likely to get wicked out.
That's it. And I wasn't. And I removed that side. And this is where it's interesting, because I like the example of spinning plates. I needed a higher strike rate at the start of my journey, right? To get me
to compensate,
there.
yes.
So then when I got my strike rate up and I kind of knew trading was legit, I could do it, I could back my analysis, then I could judge to bring down my win rate. That's what I was saying at the start of the pod, where I was like, you can argue for me a 20% win rate, but a lot of people won't do it because there's a lot of factors that are going to kick in. So that was kind of the same thing with this, which is I'll look at all my data and I know somewhere in that 8 to 12 is where I get enough of a sample size. Right, because of what the way I trade, as I said, I try to get away with stuff. Sometimes that's within like a 30 pip range. So a 30 pip range is not enough for the market to fully commit on, like, not necessarily a daily swing, but more of like a 2-day move, right? Because I would say most of my big winners are somewhere in, like, I'm holding in that like 8 to 16 hour range, give or take. Right, meaning because it could be like an Asian session entry into the London volume or whatever. Right?
You will enter during an Asian.
I
time
will,
of day is
like,
not
so because we trade all pairs, but not every pair is on watch every week, right? Because and the logic being is most price action when it's in a trade. So how do I say this? I have to think about how to say this carefully, just so people don't get it confused. There's a time for traders and a times for fundamental and economic issues. Meaning right now, gold being at an all-time high, this is due to the state of the world. It's not necessarily because the bid on gold is so amazing and everyone's like, wow, I love gold all of a sudden. So there are issues at hand that make the technicals weaker in that point. So would I trade gold right now at an all-time high the same exact way that I would at gold when it's like in the middle of a range? No, I would say in the middle of the range is actually the best for traders. When everything is at like par of its pricing, meaning top of the range, bottom of the range, and it's trading somewhere in here, that's a trader's zone, meaning it's your skill of the market or whatever. When something's at an all-time high, whether it's a currency pair or whatever, that has fundamental effects on the world. And so to say, hey, this hourly order block or whatever is the same as it was always, I think is a poor argument, because it discredits a lot of the world. Because again, it goes into the trading is everything is manipulation, which means import export means nothing, people spending means nothing, jobs mean nothing, it's all meaningless. And it's like, what a world we live in if that actually is true, you know. But on the other side, so it's that side of price action when it's being predominantly traded at like normal days, which I guess that became my goal, by the way, just to answer that the same way, which is to build my life on what can I do on the most likely repeatable day. Meaning we're not usually at war, we're not usually in conflict, we're not usually in whatever. So my Monday to Friday, so to speak, on normal days, what can the data represent that, right? So as that a strong something. So, but yes, sessions, I will likely keep them predominantly towards, like, let's just say an Asian session, I'm more open trading Aussie pairs versus euro dollar. I've almost never taken a euro dollar trade in an Asian session, right? Because it's like, it almost never will be where the volume will kick in, right? So it becomes simple filtering in that way. But as you enter and as you kind of take these positions and you understand that it's what can I get away with? What can I build upon all of it? What can I, you know, and just scaling it all up from there, right? Like,
where do you choose to keep your win rates at?
Where do I choose? I think in an ideal world, I would say 50. You know what I mean? I don't know if that's just weird, like just upbringing of you're right once, you're wrong once. You know what I mean? But with risk to reward, it keeps it healthy.
I think that's ideal.
You know what I mean? Like it just feels like you're
for
doing
a higher win rate is vanity.
Yeah.
It's like people that optimize for revenue and not profit in a business. Well, you're here to make money, and therefore, if you're only focusing on your win rate, what about trade frequency?
Yeah,
like that is a metric, because you might have an 8% growth, but I'd rather have 8% growth by the end of the month, not the end of the year.
Yeah.
So trade frequency is an important thing.
Of course.
Where do you keep your average risk to reward, or how do you even tackle it? Because if you're trading with the trend, there is like continuing with the trend in a swing
I'm aggressive
position.
on scalance. I would say that's where I've made most of my money.
Aggressive on
scalance.
What
like
do you mean by
meaning,
that?
so let's just say the market is going to run from point A to point B, right? And the structure is committed to itself. So it's not just on like a lower time frame kind of thing. Like I could see, hey, you know what? For the next, let's say 3 weeks, dollar CAD's going to go short, for instance. Within that time, I'll try to get as many shorts as within it as possible. But,
got you.
But taking it from the position that's already in, right? So meaning if my first position is running 7% and then another, you know, structure like sets up for it, I will then get in on that, move the original position onto the stop loss of the second one.
I mean, you actualize any of the profit, or it's kind of a go big or go home with the trend?
No, you're actualizing, but you're adding in as it goes. Okay. Right? And
so you lock something in, and that's your new risk for the next position.
Exactly. Right. And then so you have some in, right, with some removed of, hey, if I'm wrong, I still walk away. Okay. Like I'm always in that logic of I'll either kind of make 3% or 10 kind of logic on the same move.
Yes.
And I like that because it's somewhere in that and it's a weird one, and I always find this one a hard one to explain. But it's like there's a certain amount of money that makes no difference in your life, like whatever lifestyle you're at. Meaning I might tell you, hey Waqar, I can give you $10,000, and you're like, you think about it, you're like, it doesn't really, like, it would be cool to take an extra 10, but it doesn't change anything in my life. So me making 2%, I'm like, you know what, this covers the bills for the next few months and whatever. So 4% is not that big of a deal, but 2 to 10, very different. So if I have a constant strike rate where I can kind of hit, either I make plus 10 or plus 2, I'm so okay with that versus the person that would say, hey, I'd rather have a plus 3 all the time. Fair enough, right? But that's why I have like a hard rule of, I always close trades at plus 10 basically. Partly because I haven't been in a situation where the market goes.
I think it's so smart because you shouldn't optimize for the anomaly. And yes, you might get a
I
freak
really
event
don't.
or something.
That's
but
it. Like that's always been my rule. Never like I like that you said that because I never base my actions off the anomaly. If it lines up in that way, amazing. I've always said that. I was like, look, if I'm never going to be sad that I made 10%. And if that so happened to line up on the day where like it went way past everything, because we don't really set profit targets, but it is a degree of you're present enough to, like, with you lose alerts and stuff, you kind of know, right? So I'm like, so what happens is sometimes, let's say I'm running 10. Maybe I don't close it at 10, but what I will do is I'll lock in like 9.2, for instance.
Okay.
If it happened to go, and that one, I'll be honest,
cherry on top.
That's my little gambling in there because that's not based off like any data. That's just sometimes we're in a nice area. I'm like, the market might commit here.
Why don't you take profit objectively at a specific level predefined? It seems like you watch price arrive.
I do with counter trends.
Okay.
It's more of because it's that side of you go into the absolute side of technical analysis. So
what becomes your exit criteria in a pro trend scenario? Like let's say you got your 1 to 10 targets. Do you then monitor that zone and see if it's rejecting or continuing, and then hold?
I'll give it enough room to breathe, so to speak. You know what I mean? Because for like,
so you do like a trailing stop.
Not a direct trailing stop. I think that's a bit like...
Or a mental trailing stop.
Like, I'll still move the stop, but it's more of risk to reward in the sense of, like, let's say you have, like, a daily zone here and the next daily zone here, and there's actually nothing in between. This might be an extra 20%, for instance. And in that time where that might commit, that there might be, like... and that's the thing, but, right, it's not always just, like, where I think pure mechanical thought process loses, it's obsolete. It assumes everything's always the same. Right.
Yeah, and every market condition is unique.
Things change.
So look, I used to do exactly that. I used to have like a mental target, and when price arrives there, I have mental cues to say continue or not. And when I started to, and I think that's fine, and it was working.
I think it's just more of where's the market most likely to turn around on my trade and how aggressive.
So the thought I had in my mind one day was that there's risk reward of an entry, but there's also risk reward of holding a trade. Meaning, say if I'm 10% up or whatever percentage up, and I could maybe squeeze out another 2%, but I could also give it all back, then it becomes almost a negative. It's not going to be as extreme, but just to exemplify the point of there's a negative risk reward to hold the position, or that opportunity cost.
You're reinvesting profits for maybe not a...
more a case of you're holding the position and you could give up another 4% because it might retrace on you, and then your cutoff point comes in.
Of course.
But you might only really gain
But it's the 4%
1%.
to make how much, right? Like, that's the thing. If it's only 2% left in the bottom of the range, it's actually bad math, right?
So how do you then decide on what day do I continue? Do I hold it? That negative risk reward thought comes in.
Because right now, for instance, like, this is because of, like, I don't hold over the weekend right now. Let's say we're Thursday and I'm running 5%. I'll probably just close it because I'm going to look at the next day and be like, okay, if this is likely to retrace, where can I lock in? If that's only like 2, I'm risking 3. Is the market going to move fast enough tomorrow? Right? I'll give it to you in a different way. You take Bitcoin, for instance, because I've been one of those people that was madly bullish and all that, right? One of the main reasons I bought at the lows was because it was down 80%. It was not this deep understanding of
buy at a discount, buy low, sell high.
But that's it. No, but it was this idea of when we were at $16,000. I remember I put out a video and I was like, hey, I think the bottom's in. It was after the FTX collapse, because usually with bottoms there's also a big event, a big liquidation, some big fear in the market that, hey, this is over, right? Fine. And I remember every time I was like, oh my God, there's this level here at 12K or whatever. That to me, again, kind of going back to the 80% logic of if I bought at 16K or 12K, is my holdings really going to matter? And more specifically with the alts, right? When you get in on alts at lows, the thing is you won't know we're in a bull run until we're kind of like not halfway through it, but we've kind of went a decent up. I'm sure you've heard of like a dead cat bounce. A good one to study actually is post-COVID crash, right? That first one that happened in March 20. The movement from the drop to the high was all just exhaustive price action. It all looked fundamentally, there was nothing impulsive about it. And then you hit a new all-time high and people are like, it's a fake all-time high. And it's like, what does that mean to have a fake all-time high? So I always bet on what can I what can I get away with? 16K Bitcoin back to the high of 69. That's what I know I could get away with. Why? Because we've already done it.
Yes.
I'm betting on what's already happened. Now, as we sit, I think at the time of this podcast, it's like 66K or something. We've already been past the highs and all that, but we're sitting at roughly 66K. The question is, well, how far can it go? I don't know, and I don't care to know because I have holdings that I'm in, and I could leave it, right? And even so, a lot of my alts from the bottom, right? Because I'm in at like such a great price, I'm at a free risk reward. And what I mean by that is a lot of these alts are up 100% from their bottom price, right? Something I bought at 30 cents is sitting at 60 cents. Great. But as the market and capital rotation kind of kicks in, I have two options right now. You could say, hey, actualize the money for 100%. But I'd actually say, you know what? If the markets were to drop that 100% back, that would actually kind of show that this the bull run is over now already, because a lot would have to happen in the market to get back to my entry point. But if the run were to keep on going, and if this is the run and this is the one that whatever, and because, you know, eventually utility will actually take over more and a lot will happen, I have a free ride of I can make a 10 to 1 on my positions, or I can get out for, so that to me is an asymmetrical risk to reward. Because making 100% in crypto, and I don't want to say like to minimize returns, but when you're doing a long-term hold for a 1-to-1 in that way, it doesn't actually fully make sense. Whereas if you can get in right and remove risk at the right tables, meaning I'm not going to hold if it comes back down for my break-even mark, I will sell for a break-even. But I'm running now the possibility that if this market is now going to go from embryonic to more mature, there'll be significantly more liquidity, and, you know, you keep up with like everything that happens, but you're not unaware with it. So it's always putting myself in a position of what can I actually get away with here. That's, you see what I mean when I'm putting that on, like, I understand my technicals that come with it, and it's not being ignorant to things, and you're not being wishy-washy. Like, I was never a moon boy in the sense of, oh my god, this is gonna be the fall of like the market and then cryptos are gonna take over or whatever. Going back to the example I said with the teacher, it's the same thing when people say cryptos are gonna, I'm very bullish crypto, but I can also tell you society's not ready for crypto. Right, like we're not there yet. If I ask you, hey, does your mom have a Bitcoin wallet? No. Okay, there's half of society unable to like use it. So we have to now force it in the back end. Okay, now are the people on the back end, meaning like back end companies, SaaS, whatever, are they willing to use it? If the average demographic isn't, there's an argument to be made we're not just there yet. Now, would it happen with just enough money kind of coming in and find its way? Yes, but that could be a 5-year period. Can you hold it? Can you be fine in that time? Can you get out? And a lot of things, even if you use a conventional example of oil versus electric, I think we all agree that the world's going electric. The question is when. If you follow the Paris Treaty or whatever this person said, I think that it went from 2025 to 2028 to 2030 to, I think 2030 is right now still the leading where the world's supposed to be fully electric. And then will we? And you know, and in that time, prices will go up and down, and that's where money's left on the table, is marrying a position in a way that you're not acting on information. That's where I've been very good at, is I don't marry anything. Like, I'm very objectively neutral in that way. Do I have my heart like hurt sometimes? Meaning, like, if I held something for 2 years, like a long-term hold, and I had to sell for break even, part of me was like, oh man, that sucks. Right. But I will still sell it. Like, I'll just bitch about it, but I will still sell it. You know what I mean? Like, that's kind of the same idea with something like that.
We've had a phenomenal podcast and we've touched on a lot of topics. The kind of areas I want to finish off on is more about yourself, in terms of where do you see yourself going, in terms of what are your short-term and mid-term goals within your trading.
I intend to take this the full way. I'm a very competitive dude, you know what I mean, in this, and it's funny, I'm selectively competitive. You know what I mean? Like, we can be at home playing something and I won't care if I lose. Like, I have no... But the things I commit to, I do want to be improved. And partly because I like the daily challenge. I like the idea that you can't actually solve the market. And I think that takes a lot of terms for people to get into, is, you know, it's, I think for a lot of people, they want to know the answer, get to this point. You know, they want to treat trading as the medium in which, you know, gives them financial freedom. And you know what? To a degree, you can do that. But I think for someone like myself, in the same way like a football player or whatever, it's like I want to take this as far as I can go, right? Like, that's why, like, even in learning how the back end worked on a lot of these things, again, you can be someone who trades $0 on the lower time frame really well, and that's your bread and butter, and that's it, that's all. And genuinely, I have no problems with that. For myself, I like to see how the whole thing kind of comes together, how to move money, how to build the bigger side of things. So, you know, the last few years for myself was obviously, you know, scaling up, you know, and just getting used to higher levels and meeting new people.
Is this a financial motive or more curiosity? Excellence?
No, I'm yeah, it's one of those things of, I don't know, maybe it's just an obsession of being the best, I guess, at some point, you know, and it's that side, because again, you pass a certain point financially where it doesn't, like, for myself, I love restaurants. Anyone who's close to me, they know that's my thing. Restaurants aren't inherently that expensive. Like, it caps out. You know what I mean? Like, probably one of the more expensive things I've been to was this omakase in New York. It was like $700 a person, right? And you just wouldn't do it every day. Like, not even if you were unlimited money, it's 3 hours. You know what I mean? You're not going to do that every single day. So what ends up actually happening, like myself and my girlfriend, it'll be like $150, $200. So the financial side of things, it caps out.
Yeah.
You know what I mean? And so, but that's the thing I enjoy more, so spending like restaurant, good food with a loved one and whatever.
Financially, what was that for you? Let's say the 80-20, where you basically got majority of the fulfillment that you have now, or spending luxuries that you have. What was that income bracket where you basically had everything covered that you want to cover?
I think it was after I had passed the 500k mark. I think that was like, and not necessarily because it was 500. It was more of, you make 2-3% on like 500, you're chilling, right? Like it's not unless you're doing something for the sake of doing it, like where you're like, hey, I need to be spending all these big things in Dubai and whatever, you know, like that's the side of that was never alluring to me personally. Like I've done the phases and then I got out of it just as quickly. It was the same thing with like even in COVID, right? I was gonna be that guy. I was like, oh, I need the Lambo and I need this and whatever. And you know what? When COVID hit, like I love driving. It's not just the Lambo. Like I generally like driving's my meditation. Okay. You know, like my road and wherever you're going kind of thing. You know, don't need a destination. And then during COVID, I was like, man, like the car wouldn't do anything right now. Like, you know, it wouldn't solve what I was kind of feeling, so to speak. You know, so for myself, I like understanding the puzzle. I like seeing the bigger picture. And I think there is an addiction to seeing the world move before it happens, because the markets do kind of have that. And if you can kind of see it ahead of time, there's the part of me that's like, man, like I saw this like even simple things, like, you know, like at my mom's house, we locked in for the mortgage at the time at like a 1% mortgage rate. You know what I mean?
Well, that's a great thing now.
Yeah, exactly. And at the time I was like, hey, like I was like, this can't really go that much lower. And I was like, lock this. She's like, are you sure? I was like, trust me, just do this, right? It was like 2 years later, it was at like 6-7%.
Yeah.
You know, and for people that's a lot. And I was like, this is a joke now. You know, you've locked in on this, and it was simple things like that of just understanding stuff that ended up saving my mother a lot of money in that way, and things like that, of little choices of things that will survive the test of time. I think building generational wealth is a fascinating like thing to do, because it's like, can you stand the test of time? You know what I mean? Like in looking at the average case, a lot of parents are passing on debt, not a shot, just the data. And it's like, okay, what did they mess up and what did they not see coming? So in doing so, it's like, can I build something that can grow? And I think that to me is the really cool part, and the things that unlocks along the way. There's levels to this world. There's, you know what I mean? Like
what I'm understanding from you, and I think I'm pretty much aligned, is that money is a taboo topic, which is weird. And coming from an immigrant family, and I'm just speaking on my parents' perspective,
we're probably the same.
Money is important, and it's a vehicle to survive and all these things. But wealth was never important. Sure, bro. But yeah, wealth was never important in the case of.
Sorry.
Wealth was never that important in the case of my parents don't care for luxuries. My parents don't care necessarily for, you know, having fancy things and having a crazy car and all of that. We're fairly simple people. It was more, can we pay the bills? Can we the normality and pay for good education? That was a paramount, and that was their worldview. And when you talk about money to a lot of people that are from the older generation, or even certain people on social media, whatever, it's like, you're so money orientated, why are you chasing money and la la la, and they assume it's like to forego other things. It's like you only chase money and then you have a terrible life. Well, what if you have a good life and you also pursue money? What's the taboo about that? And what people realize, that like yourself probably, is money is also a reflection of performance. And if you got in your high school you're doing some racing events and you got a record, you'd be like, everyone would praise you. If you won a game, everyone would praise you, meaning excellence was praised. But then when there's excellence in finance, it's like, oh, you're too money hungry kind of thing. But it also reaches a point where myself too, and yourself, like the basics are covered, and anything that is excess is nice and fun, but it's not the primary driver. The primary driver for wealth was when I didn't have the money. When you have a little bit going on, it's like, it doesn't really get you out of bed in the morning. If you could also take a lie in that day.
I would say for myself, the part that I left out there, like not on purpose, was I seek information. And there's
your curiosity driven.
There's things that move this world. Again, I'm not talking like a matrix, well, maybe like a half matrix logic, right? But that to me is more of a power dynamic, in the sense of like, atop a company, major CEO, I don't know, Elon, whatever, when he tells the whole company to do something, that just trickles down, so they all follow it. But you take that logic from a world point of view, of course it's going to lead to X amount of individuals, right? Now, it's not necessarily about this conspiratorial malicious power. It's more to do with, there are things out there that exist that not many people know about, because they would never have the chance to see it, you know? And that was the thing of like, even when taking on trading seriously, you know, I used to go to house parties and whatever, and I was like, you know what, the house parties will always exist, and it will always exist for everybody. And that was the side to me that I was like, I wanted a life that not necessarily everyone could have, and not out of like ego of like, I have and you don't have it. It was more of, you know, like death comes for us all in the end. I know I'm not trying to turn this like super morbid and stuff, but if you get that 7 seconds they say you do, or the reflection, or if you get a review of your life, like whatever happens, there was a side of me I was like, you know what, I got to do it all. And the only way that I know that I can do it all is by having more money, you know what I mean? And allows you to do that. Like, I am that guy. I've done everything from skydiving to, like, you name it. There's very few things I haven't done at this age. The only thing that's left is access. and meeting the right people. And part of that is in meeting the right people is you have to be someone they don't want to meet. So that keeps me going. You know what I mean?
Yeah.
Like,
you know, that kind of stuff of just, I had a billionaire on the show.
okay.
And amongst many things, the one big takeaway was like, there's levels to everything,
Yeah.
and access, the word you use. And he was just talking about something that went completely over my head, but it was along the lines of a very high level of financial literacy, where he was able to maneuver certain companies and certain regulations and buy some machinery from Germany and import related. It was a whole complicated loop. Basically, to say he was able to get a line of credit of 300 million, and he was using that line of credit to do something very simple. I think it was just an import-export situation. He was doing simple import-export, but he was able to leverage things he had and the banking access he had and so forth to get a line of credit of such an amount to do something so simple of import-export, and he was able to print cash doing that. And in theory, anyone could do that, but you don't have the leverage, you don't know how to access the banking system in such a way and so forth. And yeah, as you increase in life, it's you have access to people and resources and power, let's say, but it's all downstream of you got to have your own finances sorted out.
And it's knowing the right people. The things come right. Even recently, like I had to change the brakes on my car. You know what I mean? At Audi, they were like, I think they quoted me like 8K for everything, but I knew the right guy, and he was like, hey, 4. Same product, same OEM, same everything, 50% off, right? And it's like, why would I pay the full price at Audi just to say I did at Audi for the exact same thing? That guy, funny enough, used to work at that exact Audi, right?
Okay.
And that's how we became friends. And I became friends with him just because every year he fixed my car. I gave him a gift on Christmas. I was like, hey, thank you.
They go along
Everything,
with
but that's it. It was like a bottle every Christmas, $50, $60, whatever it was. But that built that connection, and in doing so, but that's the same thing with knowledge. Is like as you kind of level up, I know people in things that they're really good at. They ask me for something in trading. I don't mind telling them, because I'll be like, hey, like I would be like, hey, I bought this crypto today. But I also say, by the way, I'm holding this for like a year. So price in the next 2 weeks doesn't matter. I'm just letting you know, hey, I'm whatever. Same thing with them of like, hey, I know a guy. People help each other. Where people network wrong is almost this idea of like, hey, Waqar, I want to learn from you, and I'm just there. And it's like, why would I, like you or me or whatever, just dedicate my life to you now? And it's not about this whole thing being utilitarian, but there is a degree of the world has to move. Like we have our own life. Like you see with trading all the time. It's like, hey, if you're so good at trading, why don't you just teach it for free? Do you know how many people quit trading and what a poor investment that is? The amount of students, even just internally, we've seen it. Someone will be there for 3 years and like, hey, we're done. Imagine putting your heart and soul in someone for 3 years and then they leave. So it's a hedge for time. It's a hedge for yourself. Now, hey, do you teach the person close to you? Yeah, I know with my inner circle, I've set them up in a way where I trade for them, but they do their part, meaning some of them got second jobs to add more money to their account at the time. I was like, like, help me help you. I wasn't like, don't give me 3K and ask me to give you like 3 million. But I was like, you know what? If you can get your account to 300K or whatever, I can like take over from there where it replaces your income or whatever and stuff like that. And we mapped down, we're like, okay, assuming linear degrees of math, takes 5 years. If they commit to that, I have no problem trading it because they've been all in on the plan kind of logic, right? So as I've grown, they've grown. But as I've leveled up and met more people, that's been the cool part, because exactly as you said about moving the money, something so nichey, it's find out the shit you can't Google. You know what I mean? Like that's the thing when people say even like, oh, just find this, everything you need to know about trading is on Google or whatever. I was like, that actually assumes the predominant Google search is all profitable traders, right? Like I remember a real quick one. It was with like FXCM. They're one of the top regulated brokers in North America. And the Trustpilot was like 2, right? And they're regulated, meaning like if they scam, you're paid out up to $1 million or whatever, like by the government like regulation, right? And I remember the time reading the reviews, I'm like, oh, they're so bad. I was like, oh shit, like I don't want to be with them. So I was looking for this 5-star broker and I couldn't find it. And then I clicked on it. I was like, the people reviewing this product are probably all people that lost money.
Yeah.
And so they're all saying, they're like, oh, they stop hunting, they do this and do that. And I was like, bro, surely they can't be stop hunting all the time and it's just chill, right? It was the same thing with my Forex funds. When they collapsed, everyone was like, they slipped them to hell. I was like, let's be real here. They were probably slipping maybe the top traders or certain cheaters, not everybody, because they would not have been the number one firm. You can't intrinsically offer a horrible product for years. And everyone's like, hey, you're number one, but we know you're scamming all of us and we will continue to give you the money. It's like, no, most people probably genuinely failed. But then when the slip them to hell like thing came out, they were like, this is why I failed. And it's like, that's your own setback right there versus, again, as I said earlier, it's down to the data and how well you can synthesize it. And the same thing, I was like, okay, no. I was like, what is FXCM going to do to me if like, okay, they might manipulate something here and there, cost the business. As long as the frequency is not there, right? And that was kind of the same idea of learning that. And, as you level up, people teach you these different things. And you're like, okay, cool. And you're excited to pass it on to others that reach your level or like parts level, right? I think that's the cool part. And that's what I look forward in teaching because the conflict of interest is not there. Like it doesn't hurt me to pass on certain things. So it's cool, right?
There we go. Abdu, it's been a epic podcast, epic conversation. I like how deep we were able to go. I know you guys do almost an annual retreat to Dubai.
Yeah.
So will you be in town in Dubai? I guess.
I think it might be sooner even as well.
Well,
like
let's
end of year, and I think it might be a sooner one as well.
Epic, bro. We'll run a part 2. But man, thank you very much for your time,
as always.
flying in and having an epic conversation. And hopefully the viewers loved it too.
Hope everyone enjoyed it. Thank you.
Boom.